However, that's a volatile kind of number. We knew there was a shutdown in the fourth quarter. If you look overall and smooth it out of what we're getting on productivity, it's a really good story. So you can look basically at the year as a whole. So we saw basically 2.5% year-over-year increase in Q4. So for all of 2025, productivity increased 2.2% from the prior year. And that's better than the 1.7% average rate that we've had over the last 20 years. And better than the rate of the last decade of 1.9%. Evercore did a really deep dive into productivity. They say the best is still ahead because of AI. And here's a good chart. It really started during COVID. I mean, COVID was a positive productivity shock. Why? Because companies figured out
technical difficulties, but we are back,
and they
team.
figured out how to, I mean, the digital trends were already in place, like cloud computing.
Blame it on Dr. Joe.
But it really benefited companies, which was, I think, a huge surprise as we all sort of went off.
Yeah, well, as somebody who was very much against people working remotely, I always thought that productivity would be increased. I mean, perhaps other things that are harder to measure, but certainly that as well as a result of people being together. But maybe that was not the case.
The post-pandemic trend, as you just saw in that last chart, is super strong versus, say, the trends around the 2010 era. And then we're now, as Evercore was noting, David, why economists are so obsessed with this. Productivity is kind of considered a magic bullet, right? Where you produce more, you have more growth without.
There may be more jobs will be created that we can't even imagine, and we certainly all hope that's going to be the case. There still may be some pain, even with the optimistic scenario.
Absolutely, and like
as
that
people
bridge
have to be
where we have to
retrained
reskill.
reskilled, and new jobs come into play. All right, let's move back to the broader markets this morning. Oil prices, for example, they're rebounding a bit today. Of course, they dropped very sharply yesterday. Airlines closely monitoring the movements, given, of course, the importance of that commodity. United CEO Scott Kirby recently saying the company assumes oil will reach $175 a barrel, and as a result, it will cut some flights in the short term. He joins us now. It's a first-time CNBC interview, and with him in Los Angeles is our own Phil LeBeau. Phil.
Thank you, David. We are on a United Dreamliner, a brand new Dreamliner with the new Polaris first seats. Scott Kirby, thank you for joining us here today. We're going to talk about this here in just a little bit, but first I want to ask you about, and David set it up here, your comments about planning for higher oil for longer. There are more than a few people who sit there and say, come on, $100 a barrel is your assumption through 27? Why?
You know, I think if you sort of start looking through what's happening in the Middle East and how long it's going to take to recover, even once the Straits of Hormuz are open, it seems like a reasonable assumption for us to make. And so we want to plan for something like that. We hope it's better, but the cost of planning for something like that is pretty small. We're going to do a little less flying. than we otherwise would. Willing to leave a little bit of demand on the table if oil prices are lower, but want to be prepared for a scenario where oil prices are higher for longer.
Yesterday, our Brian Sullivan was talking with the Energy Secretary, Chris Wright, and he basically said, look, I understand why he's got to do this as a business leader, but I think he's wrong.
Yeah.
What's your reaction to that?
I hope he's right, but we're going to prepare for it to peak higher this year and stay at a high level all the way through next year. And I hope he's right, but I'd much rather be prepared.
You're not seeing demand destruction yet in terms of customers who are willing to buy a ticket for a vacation or a business trip. Does that surprise you, given the questions that we're hearing about the broader macroeconomic uncertainties?
Yes and no. I mean, the demand is incredibly strong, but the reason, and in a way that would surprise you, but the reason I'm not surprised is because air travel actually from pre-pandemic to through 2025, prices were down 2%, inflation up 25%. And in that world, like, we're starting to recover. We've recovered about half of that to start this year. So it feels like there's more room to run on pricing to just catch up with inflation. And so those two forces are counterbalancing at the moment.
One of the things that, and you've had a couple of fare increases that have gone through. Do you foresee substantially higher fares this year from here, even after raising them?
I think fares will continue to go up in line with oil prices. I mean, in any business, but certainly in airlines, you've got to pass through the costs of the inputs, and that's our second biggest cost behind labor, and that requires all airlines to raise fares to pass it through. It'll probably mean less flying as a result, because there will be some less demand. Elasticity exists, so there'll be less flying. That's part of what we're doing. Get ahead of it with a 5% capacity reduction. All of those things are going into our calculus.
And we should point out, those are primarily your least profitable flights, your Tuesdays and Wednesdays,
Saturdays, red-eye flights. The lowest revenue flights that when fuel goes up, they'll start to lose money. And also, as prices go up, you do start to have an elasticity effect if there's less demand. And so we're just being proactive about that.
Let's talk about the new Polaris suites here. You've added more premium seats, not just more, but you've upgraded what you're expecting people to pay for over the next several years. What are you hearing back from customers in terms of their demand to say, yes, I want a pod with a lie flat seat, not just on international, but increasingly transcontinental flights?
Customers love this product, and we just never provided enough premium product for customers. And as we're providing it, we're seeing that the demand just is even higher and higher. And United was born on third base with where our hubs are. We've got the best internationals departure points with Newark, Dulles, San Francisco, and because that puts us really in the pole position to take advantage of premium. And this airplane, I think, from nose to tail, is probably the best airplane of any airline in North America or European airlines. We're really proud of this product, but it also is nose to tail. There's plenty for the economy class as well on this airplane.
Is premium revenue outpacing the main coach now for you?
It is. Coach has started to recover, but premium has been outpacing economy really every year since we've come out of the pandemic, and so it's just building and building and building. And really, I think there was untapped demand that we're realizing as we put the product out. Customers want to buy this.
Quickly, I have to ask you about the accident at LaGuardia. I'm not going to ask you to comment on the accident itself, but it has raised questions about congestion at airports. And the question is, have we hit a point where there needs to be greater control in terms of slot control or limiting flights coming in and out of airports?
Well, first I'd say kudos to the administration, to Secretary Duffy and Administrator Bedford. We've been asking for years to get investment in the FAA for full staffing and for technology, and they're on the road to doing that. You look like even at the New York airspace, it's a tragedy what happened at LaGuardia, and our hearts go out to our partners at Air Canada for their losses there. But you look at what's happened. They moved the controllers to Newark, for Newark to Philadelphia. We now are higher staffed in Newark than we've ever been in my career, and we're going to be 100% staffed later this year. That also takes pressure off the other two airports in the New York airspace. But we need to continue that investment in the FAA. And I think to your point, like every country in the world uses slot controls. You only have X runways. There's only so many flights that the airport can accommodate. In the United States, we've not done that. We're starting to under this administration. The FAA is effectively slot controlled Newark. They're in the process of putting limitations on at Chicago. I think we as a country are going to have to come to grips with, you only got so many runways at airports. You can't just add an infinite number of flights, and we're going to probably need slot control.
Tarmac communications gets a lot of attention, rightfully so. Should people be worried about tarmac communications? Because there are vehicles that are driving. In this case, it was headed to another aircraft in emergency there. But this happens all the time where there are vehicles that are driving, crossing runways. How concerned should we be about that?
There's really good processes and communications for this, for what are happening at crowded airports. We'll go through the investigation with the NTSB and the FAA, see if there's things to learn at crowded airports. But the underlying procedures and policies are good. And usually a situation like this, it's compounding things. There was an emergency on a United airplane. And so there's a lot happening at the airplane, while an emergency vehicle is coming there and while an Air Canada plane is landing. But the procedures are really good and solid. But we take anything like this as an opportunity to see, can we do it better? Is there something to learn? And we probably will learn some things from this tragic incident.
Quickly, whenever we get together, I like to ask you about what you're seeing with corporate business demand. So is this holding up? Is steady?
It really is. Both leisure demand and business demand are really strong, and they're strong everywhere around. Of course, with the exception of the Middle East, they're strong everywhere else around the globe.
Scott Kirby, CEO of United Airlines, on the new 787 Dreamliner in the Polaris suites, guys. And look at this. They have little doors here now. You can lie flat seats. It's quite the upgrade.
Fancy.
Thank you, Phil. And Scott Kirby, of course, as well. Still ahead right here, we're going to talk about news, of course, from Apollo and Ares, both of those alternative asset managers, private credit funds, one of them for each, have curbed withdrawals. Of course, it continues to sort of have that swirl of concern around private credit overall.
And Mark Zandi from Moody's says recession odds are rising, and they were rising even before the war. We're going to talk to him about what red flags he's seeing in the economy. Squawk on the Street. We'll be right back after a quick break.
Welcome back. Stocks, as you've seen, of course, pulling back this morning. Off session lows. This follows a significant rally yesterday in the broader markets. Let's bring in former Goldman Sachs Asset Management Chairman, former UK Treasury Minister Jim O'Neill. He's now the chair at Northern Grinstone. Always good to have you, Jim. I guess first off, how do you even try and navigate a market like this where at any moment the president could come out and say something that we're trying to understand and may not fully understand, but it's going to have a significant impact on oil and stocks and who knows what else?
Pretty good question. I'm glad I'm not trading the markets very high frequency. You know, my own approach is you have to sort of stand back and think, what is the logical path going forward? And that led me to believe that something like what Trump said yesterday would be pretty inevitable, because I don't think the US can afford it. I don't think he can afford it politically. And it's obviously going to cause a lot of damage to other important countries around the world if it carries on like this. So aspects of it remind me of the build-up to coordinated policy action in '08, in actually 1998 with the Asian crisis. And I have to say, looming in the background is the Chinese, who I would imagine are thinking we could come to the rescue again here, because they've obviously got an influence with Iran, and they're due to meet President Trump in the next few weeks.
Meaning what? I'm sorry, what are your expectations there involving the Chinese, Jim?
I think the Chinese got a lot of sway with the Iranians. It's very interesting in all this focus on the Straits of Hormuz being shut, which they are to American or Western, let's call it generally Western ships, but I think some are getting through that going to China and India. And you know, the BRICS group, which obviously I'm pretty famous for, has become BRICS Plus, and Iran is one of them, which I presume the Russians and the Chinese were behind inviting them in, what is it, 18 months ago. So I think the Chinese probably have a lot of, out of any country that has a lot of sway with the Iranians, it's probably them and maybe Pakistan and a couple of other Asian countries who, in times like this, will be looking to think, well, what can we do to negotiate an agreement where we can get something from the US or the Western countries? And that's what China did in '98 with the Asian crisis. It's kind of what they did in '08 in their role in putting the financial crisis to an end. And I can imagine, and I've thought about this for the past couple of weeks, they've got a role to play in this, because it certainly seems clear to me, which I know might not go down well with your domestic audience, Trump needs some help because he's taken on board something he neither thought through properly or hadn't really anticipated.
I totally disagree with everything you say, Jim. I think.
I thought you might do, Sarah.
But Jim, you know, the bottom line, and I think the investment implications long term, that's what we're trying to figure out here. And I think something you're raising and sort of talking around is where the balance of power lies. And you see it now moving to China, it sounds like. And a lot of people look at what's happening with Iran, with Venezuela, as the U.S. reasserting, you know, its dominance globally and you know, promoting Western values and all the things that go with that. And they look at the dollar, which has strengthened, as the winner.
Well, I think when I was on with you a couple of weeks, right at the start of this, it was pretty obvious to me, as is always the case with when a crisis happens, what are very large consensus trades, which included being short the dollar, with us going through yet another version of this is the end of the dollar's dominance, means that people got out of those positions along with everything else that they were long of. I'm not sure whether that really means that the dollar is a winner. It's far too early to tell that, but the other important thing in that regard, which is why it might be a winner, is as of course it means that forget about the Fed cutting interest rates any time soon, and in fact the Fed's going to keep them stable or raise them, and the dollar would be a winner, at least cyclically. So the dollar's reaction is kind of pretty logical given what's happened so far.
But I guess to my bigger question about the, you know, where the center of power moves globally, both economically and geopolitically. You know,
I mean,
look,
what's
happening with the Arab world and with all of these other countries, Saudi and Bahrain and all these countries now coming, not necessarily fighting with the U.S., but backing the U.S. here against the Iran war does change the whole situation geopolitically, doesn't it?
Well, so you and I we should have some kind of conference about this, because I don't share that. I mean, one of amongst the many things one can conclude 3.5 weeks into this, those Gulf countries that had such close relationships with the US because they were pretty sure they had the US security behind them. They are not thinking that right now because a lot of them have had a lot of things bombed, and a lot of people are leaving those countries and they are completely shocked about what's happened. And that's amongst the many things I meant earlier about how the US had obviously not thought through some aspects of the approach they've taken, because I think it threatens the depth of the relationship with some of those countries. And having been in the Gulf twice myself since just before Christmas, you can see pretty clearly that economically there's a lot more influence of China and India going on in those places than there used to be. And what I really mean is, and it's the same judgment for so many other places around the world, do they now start to give more weight to the economic side of the relationship as opposed to the security relationship? Because the security relationship isn't delivering the security that they expected from the States. And I'm saying it, and I know it's very, very tough for a US audience to kind of get aspects of that, but I'm pretty sure that's how a lot of countries in the Middle East feel about it right this moment. It could change. It could change.
It's not necessarily tough for us. Jim, let me end on Europe. You know, higher oil prices, higher fuel prices overall. I mean, there's starting to be a significant impact over there?
I mean, the mood, you know, I was on something with the main domestic British radio station an hour or so, and the mood about the consequences is dire. And of course, if it goes on and as bad as it is, because so many European countries are such big net importers of oil and gas, and especially, of course, because of the Russian issue, so much was diverted to the Gulf. And yeah, the consequences, if it stays like this, could be severe. But I quickly add, you know, and again, I've been looking at this stuff for over 4 decades. Who knows whether oil prices are going to be anything like this high in another few weeks? I think I'd semi-jokingly said to you, but it's fact. You know, I did my PhD during the second oil price crisis. And by the time I'd finished it, oil prices had started to go down, and they went down for the next 20 years. And so I, despite how horrific it all seems at this moment, I am far from convinced that oil prices are going to stay near where they are for that long. But it's very important for Europe, that is for sure.
I'm just trying to think, you know, finally, Jim, about some of the investment implications of what you're talking about. And, you know, you say Beijing, you see planning to take advantage of the strategic opportunity. Do you think then they would take Taiwan, say, sooner rather than later, ultimately, which is a big investor risk around semiconductors and a lot of other things?
I mean, my own guess would be that, on the contrary, I think the Chinese, you know, if you put it in a geopolitical diplomatic context, I think the Chinese will be continuing to subtly point out that they believe in the United Nations system of international law, which is having a little dig at the US for not having a mandate to do what they've done, etc., etc., etc. And I don't think it's got any direct relevance for Taiwan whatsoever. I do think, stating the obvious, that the Chinese leadership regards Taiwan as part of China. And so at some point, that is an issue. But I do not, I think, if anything, at the margin, the opposite is likely to be true. That the Chinese will see some strategic benefit of saying how they supposedly abide by international laws.
Jim, always appreciate it. Thank you.
My pleasure. Nice to see you. Be safe, guys.
You too.
Thanks, Jim. Still ahead, Moody's new recession call as they raise their odds of a downturn. Chief economist Mark Zandi here to break down the red flags he sees in the economy right now. Plus, updates in the DHS funding battle that's been wreaking havoc for travelers and whether an end could be in sight. But first, another morning of private credit concerns as Apollo and Ares become the latest firms to cap withdrawals from their private credit funds. We'll bring you the details when we return.
Focus once again on private credit. This is a couple of funds cap investor withdrawals. It's something that we've seen happen a number of times of late. Typically, many of these funds only allow as much as 5% of the assets under management to be withdrawn in any given quarter. And investors are asking for a lot more than that back. In the case of Apollo, equal to 11.2% of overall net assets. In the case of an Ares fund, it was 11.6% for the latest quarter. And in both cases, of course, investors were not able to get all of their requested capital back. This may continue, Sarah, for some period of time as these redemptions are more than the funds can or are willing to actually redeem in a given period, as is their right under their charters. To only return as much as 5%. The concern, of course, continues to be around software and the software companies in the portfolios of many of these private credit funds, and whether their businesses over the longer term are going to be significantly impacted by advances in AI, and therefore they're either going to lose the business entirely or lose their pricing power and deal with a slowdown, a significant slowdown in their revenue growth. And so I don't know how this default cycle, if there even is one in software, ultimately plays out.
We have not. For all the hand-wringing about it.
We have not seen defaults.
Waking up to the fact that AI is coming a few weeks ago, right?
Without a doubt. That is absolutely true. We have not seen the defaults. What we have seen is the continued concerns amongst investors, perhaps some of them retail investors who didn't fully realize that they were not able to get the liquidity they desired when they desired it. And this question of whether there is going to be a default cycle. But, you know, some would say this has now become sort of a frozen asset class. Obviously, the alternative asset managers would disagree with that vehemently. And for its part, Ares points out that they actually had a net inflow into this particular fund of $184 million during the same quarter.
Yeah, I mean, they're raising money and they're allowing redemption.
And they're allowing redemption.
And, you know, I think maybe it was a fantasy to think that it would only be money coming in forever. I mean, this is in a way the way it was supposed to work, and why they have these rules like the 5%. And I also think just the other point that I hear when I talk to people, David, and you know this and you hear this, is you really have to distinguish between the different firms. Because, for instance, Apollo, it's what, you know, $1 trillion. This is $1 billion business. It's very different exposure than, say, when you have a Blue Owl. I think Ares somewhere in between, just in terms of the overall business and the amount of money coming in.
The importance of it in terms of some of these funds. Obviously, Apollo is a huge player in private credit. Now, a lot of that is done through their insurance company, Athene, where they're matching, basically, to a certain extent, the life cycle of the annuity that they're selling and what they're buying with that money.
But well-run vehicles should be able to meet the 5%, right? That's
yeah, I mean, the question becomes liquidity to a certain extent. Do you want to sell things if is there really a market for all this stuff? Some of this structured credit in particular is not that easy to sell. You know, it's particularly structured for the company in question. That is a benefit of private credit to a certain extent, but also can make it more difficult perhaps to actually have to sell these things as opposed to just wait until they mature. We also had a downgrade by Moody's of a KKR fund as well this morning, sort of adding to this overall concern. It just keeps playing out. And then every time you see something from Claude, what's the latest thing? You know, that it can now control your computer, right? Anthropic's Claude and Cowork can control your computer.
Just another software
Once again, starts to hit software stocks and exacerbates these same fears about whether or not these businesses are going to be able to hold up in the face of continued advancements, almost on a weekly basis of AI. I mean, take a look at Microsoft shares, Sarah.
Yeah.
Down again today, despite what were two positive comments that Jim pointed out from a couple of big firms. And you can see almost 23% of its market cap gone so far this year.
Yeah, and we continue to hear from some of these companies that, you know, hey, it's going to take a while. And by the way, AI is an enabler of what we do. I mean, we continue to hear that defense from, you know, the Salesforces and the Workdays and the Microsofts.
Yep.
And we'll continue to follow the fallout for you. Speaking of Apollo, get an update from the CEO. CNBC's Invest in America Forum is happening in just a few weeks in Washington, D.C., April 15th. Mark Rowan will be there along with a number of other CEOs from all sorts of industries, FedEx, U.S. Steel, ARM. You can go to cnbcevents.com to learn more. Always a good opportunity to talk about how these businesses and why are investing and doubling down in America right now, and some of the opportunities and challenges. AI will be top of mind. Time now for a CNBC News update. Dom Chu has it for us. Morning, Dom.
Good morning, Sarah. Good morning, David. The Supreme Court is hearing oral arguments today on the government's authority to turn away asylum seekers at the border. The dispute involves metering when officials deem the U.S.-Mexico border to be crowded and can no longer handle more claims. A lower court found the policy violated federal law. This is now separate from the president's policy instituting a sweeping ban on asylum at the border. That policy also faces an ongoing legal challenge. Oklahoma Republican Governor Kevin Stitt appointed energy executive Alan Armstrong to serve the Senate seat vacated by Mark Wayne Mullen. He was confirmed, of course, last night as the new Homeland Security Secretary. Armstrong is the chairman and former CEO of Williams Companies, which is a major pipeline operator based in Tulsa, Oklahoma. And golf fans rejoice. Tiger Woods is getting back in the game. The 15-time major winner announcing he'll return to competitive golf after 13 months off for a series of surgeries on his back and Achilles. It will happen tonight in Florida at the TGL Finals, the 3-on-3 indoor golf league he started in partnership with Rory McIlroy. Golf fans, Sarah, will just love seeing Tiger swing a golf club in a competition environment again. I'll send things back over to you.
I know you speak for all of them. Thank you, Tom.
You got it.
Our avid golfer. After the break, Moody's chief economist Mark Zandi as the firm raises its recession odds to one of the highest on the street now. Plus, new reporting from David Faber over here on the takeover rumors surrounding Jefferies.
Didn't even know I was going to be doing that.
All right,
Okay,
well, get
great.
ready.
All right, I'm ready.
He's got the latest for you in just a few moments. You've got 2 minutes here in the commercial.
No, I'm good. I got it ready.
Welcome back. Stocks on edge as uncertainty grows around the war in Iran and as inflation concerns rise around surging oil prices. Our next guest warns recession risk is rising, and it was even before the war started. Let's bring in Moody's chief economist, Mark Zandi. Mark, what are you looking at?
Well, Sarah, I mean, even before, as you point out, even before the conflict, I thought recession risks were on the rise. I mean, as you know, the job market has gone flat here. We lost jobs in February. We've been not going anywhere fast for the better part of the past year. Unemployment's drifting higher, and that's despite a decline in participation. And most surprising to me, inflation, you mentioned inflation, it's, obviously on the high side and moving higher. And that's all before these hostilities have kicked into gear and pushed oil prices up. So, I think recession risks are very high. And unless the hostilities are coming to an end now, the president figures out a way to stand down, declare victory, and move on, and the Iranians follow suit, I think recession is more than likely by the second half of the year.
I think one of the big debates is just on jobs, which you point to, the fact that, we're not seeing job growth anymore. We're seeing unemployment rate rising. But it's a little puzzling because you can explain it by the fact that just labor supply is down and the immigration policies from the Trump administration has just decreased the amount of available workers, especially when you look at the weekly jobless claims, which just do not show any signs of major stress.
Well, you can't completely explain it, right? I mean, the unemployment rate is moving up. It moved up 2, 3, 4 tenths. It's actually up a full point from where it was 3 years ago. Now, if you go back 3 years ago, the rise in unemployment was a good thing because we were overheating and it was on high alert, raising interest rates. But now, the unemployment rate's closing in on 4.5%. That's above the full unemployment rate that most people estimate. And I think that's consistent with the slowing in wage growth. So, in part, you can explain the slowdown in job growth, but you can't fully explain it. And if I told you, Sarah, let's put it this way. If a year from now, we see unemployment rate rise another 2, 3, 4 tenths of percent, and we're closing in on 5%, would you have a problem with that? Would you say something else, the recession risks were higher? So the trend lines here,
probably.
The direction of travel is disconcerting.
Yeah, probably. Although, it's hard to square. We just had an interview a few minutes ago with Scott Kirby, the CEO of United Airlines, and Phil asked him about demand. Demand is great. Demand for business travel, demand for leisure travel. Coaches coming back strongly, even though business is outpacing. I mean, that they have sort of a real-time indication of how American consumers are feeling and spending and planning, and it looks pretty good. And we've heard that from other airlines too.
Well, I'm glad to hear that. But I mean, if you look at, obviously, those are anecdotes. I mean, if you look at the data, I'm not sure I'd come to the same conclusion. I mean, retail sales have gone kind of sideways here since the end of last year. Vehicle sales are down. Home sales are very weak. They're down. I don't know that the consumer is really doing all that well in aggregate. I mean, obviously, there's differences across the income distribution. But that's before people were paying $4 for a gallon of regular unleaded, right? I mean, if you go back 3 weeks ago, we were paying less than $3. Now we're paying $4. And again, for high-income households, no big deal. But for lower middle-income households that many are living paycheck to paycheck, they got some tough choices to make. And of course, those aren't the folks that are getting on United Airlines and traveling.
I don't know. The latest GDP Now estimate for Atlanta Fed is 2% for Q1. I know they sometimes overestimate, but we're looking at most economists actually put the economy around 2% growth. And I would say the bond market also doesn't seem particularly worried about economic weakness. We've seen bonds sell off more. Inflation, yes, but not economic weakness.
Yeah, no, GDP in the first quarter, that should come in strong. I mean, if you told me it was 3%, because that's bounced back from the very weak, growth we got in Q4 because of the government shutdown. So, if you say 3% growth, that sounds about right. But coming into Q2 with the run-up in energy prices, I don't know. I'm having a hard time figuring out how we're going to get that growth. And, the other thing about higher oil prices, every recession, Sarah, since World War II, except the pandemic, has been preceded by a spike in oil prices, for good reason. And here we are. So, maybe we navigate through, but I think if we do, it's only because these hostilities come to an end pretty quickly. Otherwise, I'd buckle up.
So do you think the Fed then is making a mistake, not continuing its rate cuts?
Well, they got that's the other reason why I'm concerned, right? I mean, they're in a tough spot. What do? Do they respond to what I just said about the labor market or the inflation? And by the way, you talked about the 10-year bond. Why the 10-year bond is up is because of inflation concerns. And inflation expectations are becoming unmoored. So if you're at the Fed and you're looking at this, you go, well, what the heck do I do with this? I can't come to the rescue. if the economy starts to weaken, because I have to worry about inflation expectations. So that's just another reason to be nervous.
Yeah.
And by the way, can fiscal policymakers come to the rescue? I mean, all this is happening at the same time we're getting all this juice from fiscal stimulus, the One Big Beautiful Bill Act and all those tax cuts.
Refunds.
They're hitting right now. So they're gone, as you move into the middle part of the year and the second half of the year. So no cavalry's going to come to the rescue here. We got to end this war pretty quickly. Otherwise, we're going to pay a price in the form of some job loss. We're going to get the unemployment insurance claims are going to start to rise, and we're going to get a recession.
Mark Zandi, thank you for joining us.
Yep, anytime.
Appreciate the viewpoint as always from Moody's.
Still to come right here, former Bear Stearns CEO Alan Schwartz will join us. We'll get his read on the rising concerns around private credit, whether he sees any echoes of the financial crisis. Also give you our latest reporting on Jefferies, some headlines from the FT that had the stock up. We'll tell you what's really going on.
Welcome back. The major averages are well off their worst levels of the morning. Here are three big movers we're watching. Shares of video game maker Nintendo falling on a report that they're cutting production of its flagship Switch 2 console. Stock down almost 5%. Shares of Puig brands are soaring European trading as Estee Lauder confirms it's in takeover talks with that company, but that a final decision has not been made. Puig is the parent company of brands including Jean-Paul Gaultier, and Charlotte Tilbury, popular beauty brands. And then shares of Jefferies off the highs after David's reporting in the last hour that the company is not interested in selling to Japan's SMFG, as previously reported by the Financial Times. David, what more can you share?
Yeah, I mean, there was a story saying there was interest there, and there is interest from Sumitomo Mitsui Financial Group. They have a long partnership with Jefferies. In fact, they have a joint venture as well that is currently being worked on. They own 14.5% of the company, and they're going to go up to as much as a 20% ownership. That is via an agreement the two have previously reached. But my understanding is Jefferies has no interest in selling at all at this point, and so who knows, maybe many years from now, at some point, there could be an exit here, and you would expect if they wanted to seek one, they would turn to their what may end up being their 20% owner, but nothing going on right now. What is going on is we're going to get earnings from Jefferies very soon, and we'll get a reflection of sort of the capital markets environment. They have been dealing with that bankruptcy at First Brands, where they had some attachment to it, and sort of fighting through that. And the stock, of course, to the point is one reason why you wouldn't want to sell now, in addition to so many others, is this was an $80 stock at the beginning of 2025. It's been cut in half. And as you can see, even over the last year, down almost 35%.
Why? Because of those
Well, the First
credit
Brands thing
concerns?
really hit it hard, and overall they get lumped in terms of some private credit, even though their exposure is not that large.
I was going to say, but their investment banking business has to be doing
It's been
very
doing
well.
fine.
I
Yeah,
think
it's
analysts
been
are
doing
expecting
fine.
30% gain.
And they've
in
had
that
$2 billion
business tomorrow.
revenue quarters the last couple of quarters. There would be an expectation. I think that will continue. So we'll see what the numbers look like when we get them.
All right.
All right.
Squashing that story. That's why we have you.
Yes, a little bit of a squashing there. All right, after the break, a possible breakthrough to end the partial government shutdown that is leading to a lot of long lines in many airports. We're going to have the latest from Washington. We're back in just a moment.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Discovery Houston, press to ATO.
Told you. Welcome back. Senate confirming Markwayne Mullin as the next head of the Department of Homeland Security, but A shutdown at that department is still ongoing and having major implications for travelers around the country. Emily Wilkins joins us now with a look at whether we are any closer on a deal. Emily.
Hey, Sarah. Well, look, we might see some of this chaos at airports clear up before spring break gets started next week. Senators are now saying that they finally had a breakthrough on getting the department funding, although they're not fully there yet. They still have to hash out some of the details. So the agreement, as we're hearing about it, it would fund all of DHS except for certain functions of ICE. Then lawmakers, after they passed that, would give more funding to ICE later, using a bill that would only need Republican support to pass. And remember, ICE got a huge bump in funding from that giant tax bill that was passed last year. So they really have not been impacted by the shutdown so far compared to something like TSA. I spoke with Senator Mike Rounds this morning. He told me that he thinks this could all wrap up in the next few days.
We've had some pretty good progress in the last couple of hours. Moving forward, I think Republicans and Democrats will come together to get this thing done. We want the people that are in the airports to be able to move through.
Senators will continue working on the plan throughout this afternoon. President Trump, of course, still pushing for a vote for an election reform bill known as the SAVE Act. Lawmakers are thinking what they can do is attach that to ICE funding and move it in that package that will only need Republican votes. But that reconciliation process, it's only for items that impact the budget. It's not supposed to be used for policy changes like requiring voter ID, which is what Trump wants. So Republicans will be facing a challenge in finding a way to get a lot of the education reforms Trump wants done. But that could be a problem to tackle after the TSA and the vast majority of the DHS is funded. And of course, we'll be continuing to speak with lawmakers throughout today as they meet and try to finalize a path forward that would allow the DHS to reopen. Guys?
All right, there's been reporting then that the president basically quashed a potential deal previously because of his desire to see the voter ID law passed. Is that correct?
Yes. I mean, yesterday afternoon, Trump said, look, he didn't want to negotiate with Democrats. He wanted to focus. But this is why Republicans have then come back later in the afternoon and said, hey, what if we were to pass ICE and this elections bill together? We'll do it with only Republican votes. And I think, again, things are still being worked out. We don't have final details yet. And certainly you've seen some Republicans raise concerns about this. I think, though, they're all having the chance to actually meet up today, hash this one out. And I think there's a lot more confidence today than there was yesterday.
Okay.
But you can't pass the two of them under reconciliation, right? You just said that.
It depends. I mean, the thing about reconciliation is that if you want to get creative about how you structure some of these policies, if you want to say, hey, or it's not a policy, but we'll give states, say, a grant, or we'll be able to give someone a tax deduction, and then you tie it to a certain thing, that's how you can actually get things through in reconciliation. But you have to be a bit creative about how you do it. And of course, it is subject to the parliamentarian deciding whether or not it is actually a budget thing.
Yeah, a lot of minutia. How about just open the government and pay the TSA workers? Thank you, Emily. Emily Wilkins. When we come back, much more on the rising private credit concerns. We are joined by former Bear Stearns CEO Alan Schwartz when Money Movers begins in 2. Good Tuesday morning again. Welcome to Money Movers. I'm Sarah Eisen with David Faber, live from Post 9 of the New York Stock Exchange. Carl Quintanilla is off today. New private credit red flags as both Apollo and Ares become the latest firms to curb fund redemptions. We're going to discuss the market macro risks and investor implications with former Bear Stearns CEO and now Guggenheim Partners Executive Chair Alan Schwartz.
Plus, the Pentagon's AI battle heading to federal court today. We're going to explore what is at stake as Anthropic challenges the Defense Department's decision to blacklist it as a national security risk.
And while President Trump shook up energy and equity markets this week with news of surprise Iran talks, was there actually more strategy here behind the messaging? We're joined by Yale's Jeffrey Sonnenfeld, who says that underestimating this president is a mistake and explains why it's part of his new Trump playbook book. We're going to discuss with him. That's going to be good.
Right now, we got the markets well off the lows of the session. The S&P down 0.07, the Nasdaq down about 0.5%, led by the likes of Microsoft, shares of which, while off the lows, still down some 2.3%, adding to losses so far for the year. Let's start this morning on private credit and the risks there. Shares of Apollo and Ares, KKR, many of the alternative asset managers all heading lower. This after both of those companies, that being Ares and Apollo, capping withdrawals from some of their private credit funds. Joining us now is Guggenheim Partners Executive Chairman Alan Schwartz. He's also the former CEO of Bear Stearns. Alan, good to see you.
Good to see you, David.
Yeah, 18 years ago.
Yeah.
Let's start off on private credit, of course. I'm just curious to get your perspective on it. I've been reporting a lot on it. We're seeing these redemptions that exceed what the funds themselves are willing to return in any given quarter. Does this continue, and does it pose a larger risk?
Yes, it definitely does. Let's take one step back. I mean, after the financial crisis, which I read about, after that, the capital rules on the banks constrained their ability to do certain types of lending. And so a lot of corporate lending moved outside of the banking system into the capital markets. And we saw a tremendous rise in private credit through insurance and private credit funds, et cetera. Anytime you have a very significant rise in the volume of illiquid assets without transparent transaction values, that has the potential to create spasms in the financial markets. Now, in private credit, everything was fine for a number of years in the strong market. We've started to see cracks in the foundation, I would say, over the last year or year plus. We've seen some of those cracks, but they don't get a lot of attention until you get to the point of what you've seen more recently, which is when redemptions can't be met, there is the potential effect of more and more people wanting liquidity from illiquid assets, and that can create ripple effects and spasms in the market. So it's a very important part of the financial system right now to keep an eye on.
Yeah, but I guess I'm obviously grappling through my reporting and trying to understand what the ultimate impact could be. Of course, the redemptions probably will continue for some period of time, one would expect, but you mentioned the illiquidity. What could the spillover effect then be, Alan, as what has sparked this, of course, is the concern around software companies that have been lent to by private credit funds being unable to pay back the loans at some period of time, though, frankly, we have yet to see any significant defaults in that area.
Yes, I think point number one, I don't think it's going to be as systemic as what happened with the mortgage markets, primarily because what happened leading up to the crisis was the assets that spasmed were heavily inside the banking system. And the banking system are, in essence, what I call them the arteries to get liquidity back into the market when needed or into the economy. In this case, they're off and out of the banks. The banks have exposure, by the way. It's not insignificant, but it's not a fraction of what it was in the previous cycle. So what can be the effects, though, the spasm, when people are demanding liquidity of assets that don't have any transparent value, then there's a lot of pressure on the funds to sell assets. And when there's a big demand for liquidity, it might have to come at a discount to actual value, et cetera. So it's a little less about what happened with the questions about the software companies, although that is a significant effect. What we've been seeing is, what is called shadow defaults. have been growing for a while, i.e. companies have been picking instead of paying cash when they don't have the ability to pay. So, and then if banks decide to call loans that they've been making to those funds, it can have a spasming effect on assets that are hard to get liquidity. And when that happens, people sell other assets to make up for the losses that they're experiencing.
Alan, what about Guggenheim? And you guys have gotten into the private credit business in the last, you've been doing this, have direct lending. What are you seeing in your book, in your portfolio, and are you guys doing anything differently?
Yeah, that's a very good question. Over on that side of the house, on Guggenheim Investments, we've had a very good record on private credit. We, over the last number of years, I can't remember how many, we had not raised fresh capital from outside investors, partially because in a hyper bull market that everybody's raising, it's hard to outperform. And we've tended to be, making our private credit not in the big deals that we're getting done, but finding our own sources. So we feel very good about our portfolio. And by the way, I do believe that one thing about private credit that's better than what we saw the last time is there are a lot of very sophisticated investors in private credit, Apollo, Blackstone, KKR, et cetera, that while they may have some problems in their portfolio, it's unlikely to be, dramatically wide in their portfolio. But going back to Guggenheim, I think we're going to see this. We just recently were raising some new capital, which we hadn't done in the past, because I think there's going to be a lot of opportunities to capture some real value in the private credit market of the next several years.
Yeah, and apart from the dislocations, I guess you said, in terms of the potential sale of some of those assets that may be undervalued, although I am curious how everything's getting marked these days as well. Alan, that's always a question as to how these firms, not to mention the private equity firms that have done some of these software-related deals, are actually marking things. Do you think they're too high?
I think there's a decent chance that they are. When you're marking illiquid assets, to quote market, when there's a change in the market, it's very, very hard to know what the actual market is for illiquid, non-transparent assets. I mean, back in the day of the crisis, we'd get you had to get two dealers to give you a valuation on things in your portfolio, and there were times where you'd say one dealer would say it was worth 90 and the other would say it was worth 60. Now that was a super extreme, obviously. But when illiquid assets need to be revalued, it's very, very hard to value them. And that creates a lot of, confusion in the marketplace.
Alan, I wanted to ask you about Kevin Warsh, who is someone you know from those crisis fighting days of 2008. I'm curious what you make of his appointment to be the next Fed chair and what you can tell us about way back when.
Absolutely. I'll start with way back when. I know for a fact, I was in the middle of it, that Chairman Bernanke relied on Kevin Warsh more than anybody in his orbit during that crisis, and Kevin performed at an exceptionally high level. Kevin actually was getting really involved in understanding the markets back in, I remember, 2007, before people were talking about it, just like we're saying now, and stayed on top of the markets, interacted with all of the key players in the market, interacted with Treasury, like Bob Steele over at Treasury, and coordinated efforts. And all through the crisis, he was, in my opinion, the single most important asset that Chairman Bernanke had. And so, look, I happen to believe he stayed very understanding and aware of the markets. I personally think he was the best possible choice for chairman of the Fed. But if you took a step back and you said, okay, what if the private credit or the energy crisis, the war crisis, what if we had a real problem in the financial markets and we just had to go find somebody who had the real background and experience on how to handle that? That's a time when Kevin would be by far your number one pick. So I think he's a great long-term candidate for Fed chair, but I think in these more troubled times, I think we'd be lucky to have him.
Finally, Alan, obviously I know you for so many years as a deal maker, somebody who's advised on so many transactions, continue to as well. Given the volatility in the market, I don't know, has it put a bit of a chill on deal making, or is there a fairly robust market out there?
It hasn't yet. None of us can rule out anything that could happen given the volatility and uncertainty of what could happen in the energy markets and the global markets. But we haven't yet seen a chill. There's a lot of deal making, and there's a lot of deals being discussed. And I think it's a trend, that companies in the days when it was like mergers of equals of like companies, those days have been over. So it's taken a while for companies to figure out which capabilities they need to add in today's environment, which areas they might want to get out of and merge a different piece with somebody else. So there's been a lot of strategic thinking in boardrooms to really decide where they want to go. And now there's a feeling that one has to make some moves if they're going to be able to navigate the environment that we're facing with the technological revolution we're facing. So right now, deal making is still, I think, quite active. Of course, if there's some sort of real collapse in the markets, that could change, but we're not seeing it yet.
All right. To be continued as always. Alan, thank you. Appreciate it.
Thank you. Nice to see you.
Thanks, Alan. Let's turn now to the energy markets. Oil prices are higher today. Supply chain disruptions for Asia have now been in focus. Brian Sullivan in Houston speaking with many of the top energy executives, officials, part of his Sarah Week. We have our own Sarah Week over here, Brian. What have you learned?
Like David said yesterday, every week there is Sarah Week. But here it's Sarah Week for this week. Cambridge Energy Research by S&P Global. I want to highlight a story that's not getting a lot of attention. Okay, we talk a lot about oil, we talk a lot about natural gas, I understand that. But there's something else that everybody here is kind of talking about in the hallways and on the sidelines, which is what's going to happen to the Asia markets. And here's what I mean. Qatar Energy, Ras Laffan, the biggest natural gas facility in the Middle East, one of the biggest or the biggest in the world, is offline. And in fact, it may be offline for 3 to 5 years, or at least partially offline. This is about 3 to 5% of global LNG supply, but it's massive for the Asia market. In fact, the most dependent nations on Qatar are Japan, South Korea, Taiwan, parts of China, Philippines, Vietnam, and more. This is a critical issue, guys. The last Ras Laffan got hit on March 18th. Takes about 10 to 14 days to sail from Qatar to the Asian market. So just do the math, it's March 24th. The last shiploads of Qatari natural gas are going to arrive in Asia over the next 2 to 3 days. The question is, what next? That's a massive issue, not only because those markets are critical for the world's economy, supply chains, semiconductors, technology, but also because those stock markets have been red hot. The Japanese market, South Korean market, these have been some of the hottest markets in the world over the last year or two. Natural gas from Qatar is a huge power, literally, of those economies. So we're talking to CEOs here about what the U.S. may be able to do to help. And one thing that the United States has is a lot of natural gas, about 30% more for export than we use. And in fact, we talked to the CEO of Williams, they're a huge pipeline company and AI data infrastructure provider, energy provider, about the cost differential between gas here and gas overseas and how big we produce. Listen.
It's why gas prices are $50 in Europe right now, and they're only $3 in the United States. We have this abundance. We are the world's dominant producer of natural gas. We produce about as much as the next 3 countries combined, and that's Russia, China, and Iran.
So stocks like Venture Global, Cheniere, they're able to sell more to Asia, but most are under long-term contracts, so they can't adjust those deals as much. I'm only highlighting this, guys, because I want to be very clear that it is, I don't want to say probable, but it is possible that there are energy supply constraints starting particularly in some of the emerging nations. We're already seeing it in some of the emerging economies around the Asia market because the last ships with the last bit of natural gas from Qatar are arriving. And after that, we don't know where that gas and where that power are going to come from. Literally, where's it going to come from?
Brian, do you hear discussion about the long term there? I mean, short term, obviously, these are very acute issues and we have to get through them, and they're creating major supply disruptions. But long term, I am wondering if some of these business leaders are trying to reimagine what the Middle East might look like when it comes to oil.
It's an excellent question, and yes, they are. Here's the problem. We have the gas, as you just heard Chad of Williams say, we have the gas, and there's a huge, obviously, profit motive. I mean, if we could sell the gas for $20 a unit, we produce it for $3, and that's what the Venture Global CEO told us on the record in the interview yesterday. That's going to be pure profit. The reality, though, Sarah, is the timeline, not just of shipping the gas, 3 weeks, but also how long would it take to scale up enough LNG export capacity additional. It's going to take a couple of years, but I think the longer this goes on, to your point, it will change the calculus of how we think about longer-term energy supply chains. We'll have much more, obviously, on Power Lunch, 2 o'clock Eastern. Huge topic as well.
Brian, thank you. Brian Sullivan at his Sarah Week. We continue back here at our Sarah Week, and still to come this hour, one of the street's top strategists on the sectors he thinks could resume leadership. We'll find out what they are next.
Then Yale School of Management's Jeff Sonnenfeld, the CEO insider, out with a new book examining the president's unpredictable leadership strategy and what to do about it. He lays out some of the biggest takeaways with us when Money Movers comes right back. Welcome back. Microsoft and the broader software space taking a leg lower this morning again, reacting in part to a new feature, of course, from Anthropic that would allow its Claude AI tool to work and finish tasks from your computer even if you're away from your desk. But our next guest says tech could take the lead in the market again despite ongoing uncertainty. Joining us here at Post 9 with his outlook is PNC Asset Management Chief Investment Strategist Young-Yu Ma. Welcome back. It's good to have you.
Thanks, sir.
I mean, I get your point that it's sort of a port in the storm with oil prices and geopolitics, but it doesn't look so safe if every time there's a new Claude update, the stocks sell off. So what do you do?
Yeah, there are going to be areas of disruption. These bumps are going to happen. We think this is going to be a theme that's unavoidable. But ultimately, where you're looking for growth, especially if growth becomes scarce, the tech is the area, broadly speaking. Now, certainly software has been in the crosshairs. There's been some bottoming action going on. But again, with this release, it invites another bump in the road.
So when you say tech, what do you mean?
Well, I think you want broad exposure. I mean, there are hardware names. If you're looking at AI-related plays, part of that's hardware. You are seeing some software in the bottoming names. I don't think you should completely avoid some of the stronger software players here either. But I think a broad exposure of technology, including AI-related, communications-related as well, is where you're going to ultimately find growth in the economy and in the market, especially if we get higher inflation that lasts longer than people are thinking right now.
Are you worried? Oh, sorry, go ahead.
No, why not just own the S&P? It's got a pretty high percentage of broadly speaking, technology.
Yeah, absolutely. I mean, the S&P right now is, if you include the tech-adjacent areas, about 50% technology. I mean, that's certainly a way to go. I think the question is, are you looking for more targeted exposure here? Because ultimately, this is a shock happening to the economy. We don't know how long it's going to go on. And oftentimes what we see is on the other side of the shock, the landscape looks different than it did going in. And if growth becomes more scarce, you could see that renewed outperformance in technology. So a relative play, but you're right, S&P is often a good way to go.
I was just going to ask if you're worried about the rest of the market in terms of earnings growth in this kind of environment, which is why you see tech outperforming.
That is part of the potential thesis here. I think it's in question now, and the question is how long and how pronounced the disruption is in the energy markets and how quickly that starts to permeate through the economy, both in the U.S. and globally. That can put pressure on profit margins, strained budgets in certain areas of the consumer sector as well. So there could be more challenges to come. We do think it's a time for patience and to think long term, but tech has both a defensive nature to it to a degree, but it is a challenging time that warrants patience here.
So the strategy is to stay away from sectors that are influenced by high oil prices and therefore will be margin hurting?
I think you want to be careful about being overly defensive here because there's a lot of whipsaw risk, and a lot of sectors. I mean, I think it's going to be hard to avoid if we do get months longer of higher oil prices. It's going to be hard to avoid impact on the economy broadly, and that's going to be pretty broad-based. So thinking about tech, it's just an area of potential relative outperformance and not quite a safe haven, but at least less turbulence in other parts of the market because you do have that expected growth.
With the S&P turning positive now, actually, this morning. How about financials? They're up today, but obviously have been an underperformer so far for the year, at least the big guys.
Yeah, financials, I think there are headwinds and some tailwinds here, and it depends how much the economy stables. Financials, the positive trade on that was the idea of a steepening yield curve and a very stable economy. And at this point, both of those are in question. And so I think there needs to be a bit more settling in the market and also settling in the credit space as well, particularly in private credit, but credit broadly. We're seeing credit spreads increase a bit for financials to kind of regain their footing here.
Okay, Young-Yu, thank you for coming by. Always good to get an updated point of view. Young-Yu Ma from PNC Asset Management.
Later this hour, Anthropic asking a federal judge to block the Pentagon from blacklisting that company across the U.S. supply chain. We're going to take you live outside the courthouse in San Francisco.
Plus, home flippers are now seeing their worst return since 2008. We're going to take a look at the factors most impacting that industry when we come back.
let's get a CNBC News update. Dom Chu has that for us. Dom.
Good morning, David. Secretary of State Marco Rubio is on the witness stand today, testifying in the trial of former Florida Congressman David Rivera, who is accused of secretly lobbying for Venezuela during the first Trump administration. A longtime friend of Rivera, Rubio is the first sitting cabinet member to take the stand in a trial in more than 40 years. The Secretary of State is not accused of any wrongdoing. In a sign that Russia's spring offensive may be underway, Moscow fired nearly 400 long-range drones at Ukraine overnight and also fired nearly 24 cruise missiles and 7 ballistic missiles at multiple targets across the country. Ukrainian officials say 4 people were killed and at least 24 injured in those attacks. And the Pentagon announced it will immediately close the area known as Correspondence Corridor, where reporters have been based for decades. It comes after a federal judge sided with the New York Times in a lawsuit, calling the Pentagon policy of limiting reporter access to the building unconstitutional. The Pentagon Press Association called the closure, quote, a clear violation of the judge's ruling. Sarah, I'll send things back over to you.
Okay, Dom, thank you. Dom Chu. Still ahead, Yale School of Management's Jeff Sonnenfeld, the CEO insider, out with a new book examining the president's unpredictable leadership strategy. He joins us next with some of the biggest takeaways on what to do about it for corporate America. We'll be right back. Welcome back to Money Movers. Our next guest out with a new book called Trump's 10 Commandments, Strategic Lessons from the Trump Leadership Toolbox. He argues, in part, that despite President Trump's perceived unpredictability, there's, quote, a method to the madness. Here at Post 9, joining us, our friend, Yale School of Management Senior Associate Dean Jeffrey Sonnenfeld. Welcome back, Jeff. It's good to have you.
Thanks, Sarah. It's great to be with you. It's great to be on set on Sarah Week, as Brian Sullivan reminds us.
There you go. So I think of you, you are a scholar, and I always say like an encyclopedia of corporate leadership and management. Why did you write a book on presidential leadership?
Sitting next to David, I would never win the contest he was on business trivia, but I'll come in second on those contests. So it was actually Jared Kushner's idea, as you know, because you know we're friendly with Ivanka and Jared, and in fact, thank you for helping us the last time we presented an award with Ivanka to Bernard Arnault. Sarah, she enjoyed presenting with you. Is Jared knows that I've known Trump longer than anybody in Trump 1.0, except the family and Wilbur Ross, frankly. And Trump 2.0, I know him longer than anybody in the current administration because the family's not involved. And I was the original critic is the late, great Jeff Zucker, when he was back with NBC Universal, had me writing a column each week on the first season of The Apprentice. And that would appear in the Wall Street Journal. It was supposed to do great lessons on leadership from that. And some of the lessons weren't so good. I know you find it hard to believe. He was a little sensitive to the criticism, and he got a little mad at times. We wound up becoming pretty friendly after it all, and I had actually, Zucker will deny this, but Trump will support this, that I came up with the idea of the Celebrity Apprentice, and he loved that idea. It was morphing away from a bad image for young people, leadership on TV, and to move into that. So that's how I got into this. And Jared said, look, Jeff, you understand my father-in-law. He's unorthodox. And before people criticize him or support him, they've got to understand he's different. And you can't counter him, you can't support him if you don't understand what he's trying to do. We have a lot of mutual friends, people in your line of work at other networks, who call him stupid. You know, he might not win the geography contest all the time, but he is dumb as a fox. He has strategic choices. The levers he pulls, sometimes they come off with an emotional valence. They're not impulsive. They are decisive moves. They work for him sometimes, they backfire sometimes, and you're right, that's how I call them. And that's how we got into it.
You've been critical and you've been complimentary on both. I am curious because you advise so many CEOs and you run this big CEO conference that we're lucky to attend. How you advise CEOs to engage with this White House? Because that has always been sort of a mystery for some of them.
People have to understand he's the most consequential person alive, like him or not right now. As we just saw yesterday, he moved energy markets 6%. He moved this time last year, he moved all the markets 20% on Liberation Day. There's nobody we know that has that kind of impact. And I sent you a note, if you didn't mind, I don't know if you saw it in your email, and I hope Mike Novogratz doesn't mind me mentioning that he sent it to me by just saying that everybody ought to buy this book. It was a great endorsement. I wish we got it on the jacket, but the Crypto King said, you can't trade if you don't understand Donald Trump's mind. Getting into Donald Trump's mind, he said, is more important than inflation numbers, employment numbers, who the Fed head is, or what the interest rates are. He said that this is understanding Donald Trump's mind, and that's what we get into in here. And it's hard to believe this, the first leadership scholar to actually look at him. This is not an endorsement book, and this is not one of those scolds. This is not a kiss and tell. It's not a disenchanted former member of the administration or a journalist that's critiquing from the outside, but somebody who studied the arc of his career for a quarter century. That's what's in here.
But isn't part of getting inside his mind the unpredictability of it?
There's an unpredictability. He moves the markets. He has a huge impact. But you've got to understand what he does is he operates, you know, when people were talking about the founder of Airbnb this time last year was talking about founder mode. That's kind of what he likes. And there are pros and cons to that centralized leader to have like a hub with spokes coming off. Everything comes through him. He thinks he can be more fluid and entrepreneurial that way, and that's the founder mode argument. The downside is it's an adhocracy. So you have U.S. attorneys and cabinet members and agency heads that are considered illegitimate and can't execute certain times, so the courts go against them. So,
because he breaks virtually every rule.
He breaks every rule. One of the big things he hates is divide and conquer. He doesn't like collective action. NAFTA, NATO, even USMCA that he created, he likes to divide and conquer. What's very, very interesting, that's paradoxical, that challenges the book candidly right now, is the morning's headlines in the Mideast that we're seeing that he's forged. I mean, who would have thought in our lifetime we would see Saudi Arabia, UAE, and so many. I worked very closely with Jared, I have to admit, on the early days of the Abraham Accords, is that we would see these Gulf nations lining up with Israel against Iran, as he's managed to get a coalition for it, but that's usually against his instincts. I think Jared deserves a lot of the credit for that, but he doesn't like the whole idea of organized action against him because it counters
But he has actually been incredibly effective in using the levers of power to organize against the institutions that our countries relied on for a long time, whether it be the law firms or whether it be the courts or whether it be, I mean, we can go on. And that gets to corporate America, which was the question that Sarah asked you, Jeffrey, which is CEOs these days are silent. And the reason I think they're silent to a certain extent is because they're afraid.
They're afraid of vindictiveness. When you can see that he will sequentially attack, if he doesn't like what they've said, the CEOs of Bank of America, JP Morgan, Walmart, Coca-Cola, Delta Airlines, even Harley Davidson, where the very symbol is the mascot, is the bald eagle, that the CEO of Harley had to close a plant in Kansas City, open one in Thailand to get product into the EU because of reciprocal trade sanctions. President Trump said, "Don't buy Harleys." He has a pretty strong MAGA support inside Harley riders, and the employees lean a little bit anti-MAGA there. And the CEO got fired because it had such an impact. So that was a cautionary tale. So they need to work together. So what we see happen now is you don't humiliate them. The pharma guys get together, and it works reasonably well. Trump RX was pretty impressive. I think Pfizer's the CEO helped lead that. It was very effective. It didn't get all 2,000 drugs they had in mind, but those 27, it's huge. The retail guys work together privately, and frankly, the finance guys have been fitfully, but the tech titans, and IBM has never paid a penny in their history for any kind of tithing, any extortion. Not all of them are paying, but they meet with him privately, and that's had an impact. But you can't humiliate him. It's the only thing he likes to lose worse than money is pride. And so those kind of assaults are not a way to take.
Why is any challenge viewed as humiliation? Why?
It's the way he is because he is big on grandiosity. You can fight that. You can say he shouldn't put his name on those buildings, bridges, and bills, legislation. That's the way he is. So if he's going to be our president for the next 3 years, instead of fight it, figure out a way to work around instead of antagonize him. The way he negotiates is different. Anybody you'd have from any school, any political party, any side of the aisle, negotiates by building trust. I'm an old Boy Scout. You get tinder and kindling and some sticks and branches, and you don't put on a big log until the fire's blast. That's not how he builds trust. He takes that log and smacks you in the nose. We're seeing it right now as he every Friday he announces some scary news, as he did suggesting this ultimatum, and opening up the Straits of Hormuz, is he hits you in the nose and then he negotiates.
He creates leverage where some don't see it, I feel.
Well, he thinks that works for him. Sometimes it backfires. But going for 150% tariffs against China, he gets 37. But it was 32 before. Could he have gotten it to 37 without that threat? I don't know. But it's a very different style.
Totally
and that's what you got to understand about him. And his bad news in terms of managing markets, the tip for him is that that on a Friday, because he's so, there's chapter 4 in here is how he measures his success. It's very much having to do with money, is that the bad news is going to come on Friday. The threats come on Friday when the market crashes. On Mondays, he's going to correct it. So sitting around here, if I could practice what I preach, I would do what we see, is to trade against what the bad news on a Friday and the good news on a Monday.
I was just going to say, there is this view in the market that there's a Trump put, right? That if it gets really bad, I mean, some people call it the taco trade, he'll go back on it, or that he cares a lot, obviously, about market performance, the market panic that we've seen. And so it always pays to buy the dip because Trump has your back. Do you agree with that?
I absolutely agree with that. Another kind of funny thing about him is that on one-on-one, he's very personable, despite all the fist pounding and everything else. And I know you've witnessed that. He, as we saw the embrace of Mondami or Senator Elizabeth Warren, Mayor Mondami, is that if he feels you have a strong faction, the definition of friends and foes is different than anybody else's. The attack on Robert Mueller after he passed away was pretty horrifying to most Americans across parties, but he uses a foil. This is his leadership style. But he can make friends in surprising ways. I took a left of center political scientist to meet with him actually several times. And I said, you're going to be charmed walking out of here. And each time I bring these academics in, they are. And he asks them all about gerrymandering and things. They think, oh gosh, he really wants to reform things. Oh no, not exactly. He wanted to understand that. Doesn't mean he wanted to reform it.
Really quickly, Jeff, since you're inside the head, what do you think he's going to do with Iran ultimately here? I think for anybody to believe that we're going into a ceasefire or a settlement right now, it's naive. My guess is he's a little bit frustrated right now that the Saudis and the Emiratis are public about supporting more military action, because I think he wanted to create the illusion that things are settling down, so all these advancing military assets and troops coming in there will do something dramatic. So I think he has something dramatic in mind, and he didn't want his new allies to leak that. So I think that's actually what's happening right now, but there's no way that he's putting this to rest just yet. Finishing the job.
Exactly.
All right. Jeff, great conversation. Here's the book, Trump's 10 Commandments. Thank you for joining us here at Post 9.
Thank you very much. Comes out on Tuesday, my birthday, April 1st, actually, the Wednesday.
Oh, happy birthday.
Thanks.
Happy book publishing
Happy belated birthday as well.
Thank you.
All right, Jeff Sonnerfeld. Up next right here, home flipping. That market is seeing its worst return since 2008. We're going to look at how rates and, of course, demand are playing into that equation. Back, the home flipping market coming under some pressure. Diana Olick is looking at that in today's property play. Diana.
Well, David, higher mortgage rates, high home prices, and tight supply are all squeezing investors in the home flipping play. Last year, the number of flips, which is defined as a home bought and sold in the same 12-month period, dropped nearly 4% from the year before to the lowest level since 2020. And that's according to Adam, a data provider. Investor flips accounted for 7.4% of all 2025 home sales, down from 7.6% the year before. Now, flips are falling because profits are falling by a lot. Given the highest median home prices on record, the typical home flip netted investors just $65,981 in gross profit, or a 25.5% return on investment. Now, that may sound like a lot, but again, that's gross profit, and it's down from 32% the prior year and is the lowest rate since the Great Recession in 2008. Now, as a comparison, in the boom decade following the financial crisis, profit margins for flippers were higher than 50%, peaking at 61% in 2012, which was right around when home prices bottomed. Now, net profits, or the returns after you've fixed up the property, can vary widely depending on local labor, material, and financing costs. But across the U.S., they are still under pressure. Why? Well, ongoing supply chain issues, tight labor, and tariff-related increases in material prices. So, what about this year? Well, mortgage rates are the problem because they were supposed to be falling, but they have been rising due to the war with Iran. More investors are using financing now, nearly 38% last year, compared with 37% the year before. Now, for much more on the state of flipping and a new podcast with the CEO of JLL on the Middle East, private credit, and of course AI, it is all in the Property Play newsletter. It's out now. Go to it, cnbc.com/property play. Back to you guys.
We were just talking to Jeff Sonnenfeld, Diana, about the president and, how he operates and his leadership. And this has been an issue, the stuck housing market that he has, he obviously has experience with in the real estate market. And he and his housing administrator, Bill Pulte, they've been trying to address. What have they done? Has there been success? And what do you anticipate will happen?
Well, there is a bill going through Congress right now, but it's kind of stuck between the Senate and the House. And that's the one, as you know, we've talked about, which has investors in single-family rentals really at the heart of it, trying to get them out of the market. But there's an issue because they do a lot of build for rent. And that's what we really need, is more housing stock in general. And part of the Senate bill says that they would have to sell those homes after 7 years. The House doesn't love that. There is some good stuff in that bill about manufactured housing. They are trying to deregulate. So much of the problem in the housing market right now is local zoning regulations, but the federal government can't do a ton about local laws. They can try to kind of generalize them nationally. If they were able to do that, that would help as well. A lot of the things he's proposed are good ideas. They just haven't gotten there yet.
Okay, Diana, thank you. Diana Olick. After this, we are live outside the courthouse as Anthropic asks a federal judge to block the Pentagon from blacklisting its use across the U.S. government. We're back in 2. Welcome back. Anthropic asking a federal judge to block the Pentagon from blacklisting the company across the U.S. supply chain. Mackenzie Segal is outside the courthouse in San Francisco and joins us now. Mackenzie.
Hey, Sarah. So in a few hours from now, Anthropic goes before a federal judge where they'll ask her to temporarily block two things. The Pentagon's supply chain risk designation, which effectively blacklisted the company from government business, and President Trump's directive ordering every federal agency to stop using Claude. Now, the stakes are straightforward but significant. If the judge grants the injunction, defense agencies and contractors can keep using Claude while the lawsuit plays out. And then Anthropic starts recovering what its CFO says could be billions of dollars in lost 2026 revenue. If she denies it, the Pentagon's action stays in place. Anthropic remains essentially locked out of that market for potentially years, and OpenAI, Google, and xAI keep filling the gap. Now, even though Alphabet, Microsoft, and Amazon have all said that customers can still use Anthropic for non-defense work, many have already started to offboard Claude anyway, rather than risk any association with a national security designation. And every day that this drags on, more competitors are locking in contracts that Anthropic may never win back. Also, keep in mind, this case reaches far beyond Anthropic. The Pentagon used a supply chain risk designation typically associated with foreign adversaries. And if that stands in court, it creates a really powerful precedent. Any administration could then use national security authorities to shut a domestic tech company out of government business over a contract fight. And that has every major cloud and AI vendor watching closely today. And if we don't get a ruling, which is a real possibility, that uncertainty is damaging on its own. Guys?
Even if they rule against the U.S. government, then it's up to the government, right, to use its discretion to grant some of these business opportunities, isn't it?
Well, so the DOJ's entire case really rests on the fact that this is an operational security issue, not a free speech case. And so the question that they're looking to answer today is whether or not Anthropic has backdoor access to Claude once the model has already been deployed in the context of the government. That's specifically a part of what the judge sent out to lawyers yesterday, asking both sides how much access Anthropic has once Claude is being used in the context of battle, and just understanding that access. But to your point, Sarah, Emil Michael, the Pentagon's tech chief, has already said that they've moved on. They've signed contracts to give xAI and OpenAI classified access. So they're now serving a role that was once held by Anthropic.
That said, I mean, Anthropic, with a $350 billion private market valuation, Mackenzie, has only seen its revenue run rate increase incredibly even since this decision was made. But how impactful will it be if, in fact, it is upheld?
So it was just last month that Dario said at the TMT conference that their run rate for the year is $19 billion, $6 billion of that coming in just in February. But the entire team, starting with CFO Krishna Rao, has warned that they are facing a headwind of hundreds of millions of dollars. He put it in the ballpark of billions of dollars in terms of lost contracts related to the Department of Defense, but also ancillary contracts that they might lose, whether it is related to a government agency or just a company looking to offboard Claude to avoid any sort of risk of association, something that's already starting to happen with firms out here in Silicon Valley.
Okay, Mackenzie, thank you very much. We'll watch it this afternoon. Mackenzie Segal. The other thing to watch this afternoon, David, is at 1 o'clock, there's a big auction, $69 billion worth of 2-year notes for sale. And I pointed out because the 2-year has really underperformed lately on these rising oil prices, inflation concerns, pricing out the Fed cuts. So looked at as a kind of important indicator of demand for bonds on that side of the curve, given we're kind of still in it and we're trying to figure out what President Trump's next move is when it comes to Iran.
Yeah, there we are, almost 3.9%.
Yeah, with stocks kind of hanging in there. We've been down. We were higher, and now we're kind of unchanged. Send it over to Scott Wapner and the Halftime Report.
All right, welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the market. Stocks remaining volatile today, a bit unsettled. We are attempting to go positive on the S&P yet again. Dow is in the green. We discuss and debate all of it with the investment committee. Joining me for the hour today, Joe Terranova, Carrie Firestone, Shannon Sakosha, and Brian Belsky. I'll show you exactly what we're doing across the majors today. There it is. It's a split picture. It looks a little better than it did off the open today as we try to continue those gains that we did see yesterday. 80% of the S&P was up yesterday. Oil's higher. Brent was above 100 again. So we're watching all of that. We have really, Joe, still no full details or substance on these apparent talks that the president said were happening. Of those today, Wolf says the following. The difference a Truth Social post can make. Unfortunately, we're not buying into it. And see yesterday's action as nothing more than a dead cat bounce. Could it spill into the days ahead? Sure, but bigger picture, we don't feel the bottom is in. Just before we came on the air today, 11:53. Jonathan Krinsky of BTIG puts out, assuming the S&P closes below 66.27 today, it will be the fourth consecutive close below the 200-day moving average. Okay? We suspect any resolution rally is still a fade. We'll stick with our call that as long as the S&P is under 6,800, a move towards the 6,000 level is likely. What do you say to all of that?
So what I say to all of that is, look, if you are in the wealth management industry, which I obviously through Virtus Investment Partners have a relationship with, you understand that moments like this potentially bring an opportunity because we're buyers for the long term. We believe in the long term. So everyone, with all due respect, is going to say you're going to buy for the long term. However, if your optics are over the next 3 to 6 months and you believe because of yesterday's tweet that there was a dynamic change in where you can get confidence that a bottom is in, I don't think you have the ability to find that confidence. In fact, what I see in front of me is we have actually had a significant breakdown and lost all defined trends. Find me a defined near-term trend. Volatility? Yeah. You have a higher trend there. Oil? Yes. You have a higher trend there. But if I look at the major indexes, the NASDAQ 100, the comp, if I look at the Dow, if I look at the Russell, if I look at the S&P, they have all broken down. If I look at the various sectors, they've all broken down. So I don't know which way to go. Do I want to be bearish or do I want to be bullish in the near term? And that is an uncomfortable position to be in.
Maybe you're looking for the wrong trend. And that, Brian, the trend that matters more than anything else is when the stock market gets unsettled enough for the person who lives at 1600 Pennsylvania Avenue, there's going to be a reaction. Okay, the so-called Trump put, which people have talked about endlessly. Okay, maybe that's the trend that investors need to focus on more than anything else. That's what occurred yesterday morning. That's why it's hard to get all bared up. Maybe that's why the market has reacted the way it has today. Some of the technicians out there say, oh, stocks weren't oversold enough. Well, they were to the technician who matters most of all, President Trump. They were oversold enough to get a reaction. What do you think?
I think there's a lot there to unpack, especially considering that with respect to how markets have done the last 2 years during the first quarter, number one. Number two, in terms of the technicians wanting this perfect blow-off, sell-off, in terms of the V-shaped bottom. And yeah, of course, it looks like a dead cat bounce yesterday when, like you said, when Wolf did such a great job talking about 80% of the stocks outperforming. That is a recovery rally. But I go back to last week. And when the market was trying to recover, when the markets were positive, you had this very strong broadening out. Things were all working together. Small cap, financials, value, growth. So it's not just as easy as the Trump put. I think you have to be really careful on that to build strategies longer term around the Trump put. But again, it's part of the buy the dip mentality that clearly has been working. And we, Joe, talking about investing, when you are an investor, you have to, if you're missing the 10 best days in the market, you're going to lose out longer term. So I think you have to be investing for the long term. And in these days, and in the week like we had in terms of oil spiking, Scott, you can, will, and should be adding to positions on these kind of reactive moves to the downside.
I would suggest that until earnings expectations deteriorate in a meaningful way, we're still looking at like double-digit earnings growth, then why should your opinion longer term of this stock market change in any way? As long as earnings are intact, Now, it remains a question if oil prices remain elevated for a very long time and the war carries on for a much longer than expected period of time, well, then all bets are off.
Yeah.
But until something changes, what about my perspective?
So I would say yesterday at 7 a.m., I was on a plane watching a screen, and suddenly the futures went nuts. And it showed all of us how important it is to the market to resolve this war and have oil prices come down. Dramatically important. And therefore, since it was short-lasting because there was no confirmation of it, I think the market could have been up 5% for the day. The S&P could have had a 5% day if, in fact, we had something. So it tells us that there are a lot of buyers out there. They may be machine-driven. It doesn't matter. They're still buying. What did they buy? What went up a lot? What has been sold too much?
A lot of stuff that was down a lot, like
a lot of tech stocks.
Discretionary, like all the stuff that obviously would be down was up.
Correct. So I guess we would say parts of the market were oversold. In general, all of the market wants this to resolve and wants oil prices to go down because we don't want a recession. And if you just look at what has happened in the last few weeks, the change in the so-called like heavy asset stocks, which were up on a spike, I mean, we feel that they might have been overbought, selling at about 30 times PE for many of them versus the tech stocks.
You mean those so-called halo names?
Yeah, they
right?
have been hurt more. Those stocks have come down an average of 10%, the big cap names, while the tech names, Amazon is up. The others are down at 3 to 5%. So they've done better.
So Barclays today raises their S&P target. They raise their target to 7650 from 7,400. Shannon, they say, yeah, macro risks are rising, Middle East war, AI disruption, private credit stress. But the U.S. still leads on nominal growth and tech-led secular tailwinds. We're incrementally bullish on the profit outlook, raising their earnings estimates, okay, and the price target on that to 7650. Not multiples, but earnings. Goes to exactly what I was talking about. Until the earnings picture changes, should anyone's view of the stock market change?
No, and I think to Carrie's point, she made a great point about what's been under more pressure over the last couple of weeks, and it has been these companies that I think are leveraged to stronger nominal growth and a lower interest rate environment, and that's where we saw that broadening coming into this year since August of last year. So yes, there has been some tech buying. The other thing, Scott, is that if you look at earnings expectations, firms that have continued to increase their earnings expectations for this year, Evercore just increased theirs, and they have been at the low end of ranges across strategists across the street. And I think that that's an important indication that, yes, there is this potential for margin compression. But you go back to what we were talking about in February. We were talking about productivity enhancement. We were talking about margin improvement. We were talking about all of the things that could potentially come to this broadening out, support this further broadening out. So you look at things yesterday. Yeah, tech was strong yesterday. So was materials. You're going to get potentially the foundation for this continued broadening in the market. And I think that's what's different from the bounces that we have seen over the last couple of years that have been led by mega cap tech stocks. These bounces are going to be broader in our view, and that lends itself to going back to your positioning in late January, early February, and looking at it and saying, where have things perhaps gotten more attractive? And buying into that broadening trend, because our view is that we will get a resolution and that we're still on this nominal growth path.
You want to weigh in on this Barclays raising their target? I mean, it implies that you're going to end up at like 24 times. Now, again, they say it's going to be an earnings-led, earnings-driven expansion, not a multiple expansion, but nonetheless, raising your price target on the S&P to 7650 right now is, I think, emblematic of those who are trying to look past this, saying, well, history says you should. History's proven most of the times to be correct, because once you do get past this, you're going to be right back to earnings are good, the economy's pretty strong, and you still have the benefits of the policies from the administration, all the things that people were hanging their hat on before this conflict even started.
You had about three major tailwinds coming into 2026 that were supporting the bull market that began in October of 2022. It was a disinflationary trend. It was monetary policy that aligned with investors, and then it was the earnings growth that you speak about. I don't think in any regard that has changed. So I agree that for the long term, and whatever your price target might be, I think we are higher 12 months from now relative to where we are today. I agree with that. I guess it's just what I'm advocating for is stop trying to call the near term, because I don't think there's any visibility into doing that.
Yeah, I know, but you are in a sense calling the near term, because you're probably more tactical of a person than anybody else on this desk.
I wear two hats, though. And I think you know that. I wear two hats where I'm telling people on a daily basis, stay invested for the long term. This is not an inflection point. I've said that over and over again throughout the month of March. No, but where this is not analogous to something that we witnessed in 22 or heaven forbid in 07 or 01. This is an environment, though, if you're focused on near-term opportunities and you're trying to take down and generate alpha, you're trying to be tactical, it's very hard to find any clear defined trends.
So what is the personally buying the GLD and personally buying Apple, what does that represent? Because those are two moves that you have.
That is being tactical. And if Scott, if you remember a conversation we had in January, I said to you, I think the early part of 26 is going to be about being a little bit more tactical in the market if you're going to generate alpha. And that's exactly what I'm doing. So do we all know the fundamental usages of gold and the importance of gold in the environment that we're in now? Sure, of course we know that. I don't need to sit here and reiterate all that to all the viewers. We know about Apple. We know that Apple's been one of the best fundamental companies that has ever been brought public to the marketplace. What I'm trying to identify is setups in the market where I believe I have a favorable risk to reward scenario. And that's exactly what I see in front of me with the GLD. Okay. I'll buy the GLD here. I'll stop out against 375, which is the 200-day moving average. You finally got the retreat in gold and silver back towards that critical moving average. I don't want to go to silver. It's a little bit more thin, more volatile. I like the stability I see in gold relative to silver. And then as it relates to Apple, I've traded that. Back in August, I bought it. I sold it in November. I made 20%. In early February, I tried it again. I lost 4.7% literally in a matter of days. The stock pulled back. You said to me,
that's
why
why
not?
Kramer says don't trade Apple, own it. Well, it's a hard stock to
Jim might advise that for the viewers, and he's right. But in that regard, for someone who does this professionally for a living, I'm comfortable with my record, what my track record is, that I can successfully do that. So buying Apple here, let's 253.47. Pull up the chart, you'll see it's coming real close to your 200-day moving average. That's a nice setup. That's a nice risk to reward scenario.
It was reiterated outperformed today at Evercore ISI. 330 is the price target. Carrie, you own that name too. Is it? And by the way, stock's having a pretty good week.
Yeah.
I know yesterday obviously was a big day, but the stock's up on the week to date more than 2%. It's the best performing of the mega cap names.
So it's also been in the past, I would say, the safety stock of the mega cap names.
Fair.
And if you look at some of these stocks that we have owned, but other people don't own, that I think have priced themselves to a level where anyone who doesn't own Apple, Meta, Amazon, and then I gave two others, healthcare names, Thermo Fisher would be an example, and Boston Scientific, names that are down between, they were down 12% from their high to the mid-30s%. This is an opportunity, and you can buy stocks if you haven't owned these names and feel comfortable that the earnings growth over the next few years is going to reward you for owning them. We can't all be saying, oh gosh, this is not a time because there's so much uncertainty. There's always uncertainty. We have to think about what price we want to own the stocks at and buy them.
Okay, so I mentioned it as part of the Barclays target raise on the S&P to 7650. That they identified the macro risks that you all know about, Middle East war, AI disruption, and private credit. So on private credit, we need to hit that because many of those names are lower again today, if not all of them. Well, now Ares just blinked green as I said that, of course. So there are many big stories today. They're the latest. Ares is to limit withdrawals. I asked Jeffrey Gundlach about what's been taking place in private credit, because he's been really gloomy on it, as you know. I want you to listen to what he told me yesterday regarding redemptions, especially from retail. Listen.
Anybody that has been around the block at least as many times as I have, or even half as many times as I have, should know that the next window of liquidity from these investors, particularly the retail investors, they're going to ask for a lot more than they did in March. Everybody knows this.
All right. Well, I mean, that's one person's opinion. However, it's backed up by what Guggenheim's executive chairman, Alan Schwartz, said in the 11 a.m. hour. He's pretty close to private credit. Listen.
When redemptions can't be met, there is the potential effect of more and more people wanting liquidity from illiquid assets, and that can create ripple effects and spasms in the market. So it's a very important part of the financial system right now to keep an eye on.
Right, Kara? I mean, concerns beget more concerns.
Yeah.
Redemptions beget more redemptions.
Of
What
course.
do you do with that? What
So-
both Gundlach and Mr. Schwartz had to say. You own Apollo, I think, is the one that you have, correct?
We also own Blackstone, which
Okay.
we've owned for 15 years.
Okay.
And I would say that with hindsight, it would probably have been a good idea to sell or trim those positions several months ago because they were becoming crowded. The industry had grown a lot. There's an awful lot of interest in having retail clients, advisors suggesting that they become part of portfolios. And when any trade gets crowded, perhaps that's the time to take some profits off the table. Of course, there's something different that's been pointed out between private credit funds, people wanting redemptions, and banks. With banks, you have to give the depositors their money. Otherwise, they shut your bank. With private credit, you can gate them. And will this pass? Yes. With pain, yes. Does it mean there's potentially more downside? Possibly. These stocks have gone down a ton. You know, between 30 and 50%, depending on the company. They're selling at 10 times earnings, 9 times earnings, adjusted for some of the shortfalls here. So do I think there's sells now? Probably not.
There's two issues. Could it get worse? Sure. Everybody, well, not everybody, but a lot of people believe that it can get worse. Is it systemic? Most people who are opining on that, who are either very close to those situations or just commentators say not really. I mean, Gundlach doesn't think it's systemic. Alan Schwartz went on to say that he doesn't think it's going to be systemic, but you're getting asked about it a lot, I bet. Right?
Absolutely. I would say it's probably, 1A, 1B with the conflict in the Middle East right now. Our view is that it is not systemic, and our view is based on not only our exposure to the private credit space, but also our exposure to the public credit space. And the fact that you see this in leveraged loans, you see this in the securitized market, you see a significant divergence in a subset of the loans that are issued in the private credit market and the rest of the private credit universe. Also, just to be clear, the terms of these redemptions and the levels that are set are technically part of the structure. So it's not as if you're in a situation where these are new gates that are being put on. These tenders are set at the levels that they're set at in accordance with the underlying liquidity of these assets. And so, yes, could we see continued looking for redemptions here? These are usually a yield complement to a core bond portfolio, and potentially there's some concern from investors about the opportunity to still earn that yield. And so you could see redemptions. In terms of the equities of these private credit firms, however, there also was a significant amount of enthusiasm coming into this year about a tick up in M&A. And so not only have you seen sort of this concern about private credit, you've also seen rates go up. And so there's a couple of headwinds for these companies. I think in our view, again, it comes down to, is this something where we see a broader ripple effect to credit? And our view is no, but there could be additional layers of stress in these underlying portfolios, particularly if they're not well diversified in terms of their issuer.
This has been like a full 180 performance-wise from what people expected was going to happen at the beginning of the year. When we talked about, we used the word realizations a lot coming into 2026.
Yes.
Suggesting that this was finally the moment, right? After all this time, where private equity was going to finally get to, have all these realizations, it was going to be great for business, and the stocks are all a mess year to date. 30% down, 25% down, et cetera, et cetera, et cetera, because of this issue.
And I think the strongest correlation and biggest obstacle regarding private credit's performance look no further than software. and I truly believe it.
Well, I was going to go there next. You can't talk about one without the other.
The requirement for, in my opinion, publicly traded private credit to bottom is that first software has to bottom.
Well, I've been told by people that it had.
Well, I've
been told the people that it had. I mean, a month to date, a lot of these names are up. The IGV had looked a lot better.
It had.
A lot better lately.
It had. I don't like the price action post Oracle earnings. Oracle's reported on March 10th. It has basically lost all of the gains since earning, which is disappointing to me. We own Oracle. I think if software is going to rally, Oracle, Microsoft, there's certainly Palantir, they're going to lead the way. But it would be incredibly helpful if software would find a final bottom for private credit to rally.
Well, you went back to the beginning of the show and you're talking about how important earnings are. The earnings for Oracle were great. Now, I think it answers the question whether or not it is systemic or not. And so we sold all of our Blackstone in February. We were late. We owned it for 5 or 6 years. But we don't want any public companies dealing with credit. On the software side, we're aligned. We think the ones that are going to win are Oracle, Microsoft, and Palantir. But in the meantime, there remains a tremendous amount of specter around Oracle. I go back to the March 8th report. The numbers were good. So we just have to get through this belief and prove that it's not systemic, and these stocks are going to rocket.
Software's not getting a lot of help, by the way, by Microsoft.
No.
And I mean, that's like the elephant in the room. You can talk about all these other software names. You could talk about SaaS being disrupted and what have you. But until Microsoft finds its own footing, I have a hard time believing that this space is going to perform any better. Look at the charts. Just stock's terrible.
I think it's more than that on Microsoft. We've talked a lot about Apple on the program so far today. Remember, Apple and Amazon underperformed last year. And part of that was Apple's not talking about what they're doing in AI. You had AMS issues in Amazon. And so where the money was chasing was everyone was saying Microsoft is going to be the place to be because of the war chest of cash. Now because they're having a harder time monetizing and proving some of these things in AI.
Getting called out by OpenAI.
Absolutely.
Right?
And the Copilot product and all that stuff.
Well,
so
the analyst yesterday, Amelius, was like, somebody's got to say it. There's a problem here.
Yeah, that was a great note, and it made a lot of sense. I think it's really difficult to be overweight Microsoft here just because of the headlines. So that's why we are much more overweight, like I said, Amazon, Apple, that underperformed last year.
And look, today, you get the announcement that Amazon Web Services is introducing new AI tools, and all the software stocks have the sensitivity to move lower. So, Brian, you're right. Like, we have to get away from those headlines. And I think Stephanie Link has correctly said this. There's no proof point to know ultimately what the disruption is going to look like as all these mega caps keep introducing these tools.
Feels like all of the exciting headlines in this area are from every company but this one. Right? I mean, it's like OpenAI's doing this, Anthropic's doing this, Meta and Amazon,
because
and even
Copilot
Apple.
isn't good.
Wall Street Journal had that piece a couple days ago about Apple. It's like, oh, well, they're behind. They're so behind in AI, it's been actually good. And you look at what the stock has done, kind of proof's in the pudding there.
Microsoft needs to show that they can move nimbly here, and they have an installed base that is beyond parallel. And so I think that is the challenge for them right now, is that they're sitting with, this defined enterprise base that they are not able to take advantage of right now with their product.
All right, lastly, let's talk about another area that we need to discuss. It's discretionary. By the way, market, let's take a picture of the market real quick. Just because what was looking kind of dicey has started to look a little bit better, and that's the market as a whole. Dow's good for 130, S&P's up 5, so we're all now in the green. NASDAQ's trying to get there, but it's having a little bit of a problem. In part, you saw what Microsoft's doing and some of these other names too, and some of the chip stocks are still lower. But I wanted to hit discretionary because as I looked earlier, many were lower. Restaurants, some of them have turned around, though. As you saw the discretionary chart try to move positive on an intraday basis, that's helped the market come back, too. I was looking earlier at like Brinker and Texas Roadhouse. They were red. They're now green. There's discretionary right on the line of trying to go positive. Why do I bring it up? Because you bought more Target.
I did.
What's behind that?
That's a contrarian play because I really like the new the new CEO. They're righting the ship there. We own in both our value and our dividend growth portfolios. I think that's going to be the turnaround stock. And remember, too, they were really late in terms of their online presence post-COVID. And so I think that they're still trying to right that ship, Scott. I think there's some money going back into Target.
TJX, Ross Store, we've owned both of them. We've been rewarded. But listen, Brian's not wrong. Just from a valuation perspective, Ross Store, TJX, they're rich. They're above 30 times. Targets.
And TJX was, when everyone was worried about the market last year, TJX is a defensive name because of the home goods and people go there, shop for the discount and pricing. So that was a fully loaded stock. We own it, but it was a fully loaded stock within consumer discretionary, which was a sector that has been iffy. Now remember, last year, consumer discretionary did okay because of Tesla. So sometimes the numbers are skewed in the discretionary sector. And so TJX is a name that we still like, but fully priced.
Yeah, it's fully priced, and everyone knows about off-price and the value of it. Yum China, Darden, those are two names, consumer discretionary, we own working well.
All right, I have a news alert down in D.C. I got to get to Emily Wilkins for that. Hey, Em.
Hey, Scott. Well, we are here at the Hill and Valley Forum, of course, bringing together big names in Silicon Valley, big names on Capitol Hill. We just heard, of course, from J.P. Morgan's Jamie Dimon, and he said that he had a lot of frustrations when it came to the current military procurement process. Give a listen to what he just told the audience here.
I am deeply frustrated, and I think this relates to the Department of War, too, about our own policies in America which set us back. We are unable, we become like Europe. We're unable to move and change budgeting, change procurement, let people do what they need to do. The rules in place and compliance in place, and Congress gets involved.
In addition to military procurement, Dimon also talked a little bit about the impacts of AI. He said that J.P. Morgan is set to be able to handle some of the fluctuations that could come, but said not everyone will be able to do so. He said there is a role for the government here to play in terms of giving incentives, making sure there's education, and basically helping prepare the workforce for the transition that's going to come to AI. Touched on a lot of different topics, but those two I think were really the prominent ones and kind of the big takeaways for the audience here at Hill and Valley. Scott?
Anytime he speaks, we listen. Emily, thank you. That's Emily Wilkins for us with that update from Jamie Dimon. Coming up, more moves from the investment committee. We have Brian Belsky adding to a name, up nearly 20% in a month. Kerry's buying the dip in a beaten down industrial stock, too. We'll tell you what they are coming up. let's do these moves that I mentioned. We had, Carrie, we come to you first. You bought more Flowserve, right?
Yep.
FLS, down 18% in the past month. It's still up 34%, however, in the last 6 months.
Yes.
Tell me more.
So we bought it because we liked the categories they're in: pumps, valves, seals, energy, extraction products. And we're very heavy on technology stocks. We moved out of some of them. The stock came down 12%. We bought. Now it's down 18%. We bought more, and we think there's big opportunities there.
Okay, Belsky, you bought more Netflix. It's had a nice move since they bowed out of the bidding for Warner Brothers Discovery.
Sure it is, Scott. This is the second time in the last 5 years that I put Netflix in the value portfolio, and I did it opportunistically because the stock was just getting pummeled from this deal. So we bought it February 24th, about a week before the deal went the other way, and we just knew that stock was going to. The stock we thought the stock was going to go up regardless if they got once they got the deal or didn't get the deal, but once Paramount got Warner Brothers, shareholders like that, and they didn't have to spend the money, and that's why Netflix has gone up.
Yeah, I mean, it's obviously up. I mean, you see that.
Yeah, and when you buy these opportunistic growth stocks, broken growth stocks, and put them in value, Joe used the term earlier, this is a tactical move. We're not going to be in this stock forever. It'll probably be 2 or 3 months, and we'll see how much we can get, but I think there's more to go there.
There's your 19% move. All right, some calls of the day or otherwise some movers. KB Home outperformed $77. Citizens, you own that. They report today, by the way, right?
Yep.
You own that stock?
Yeah. Now, this is a company that has done amazing during this malaise with respect to housing. $600 million back to the shareholders. Revenue guidance looks pretty good. This is, again, from a small mid-cap perspective, this is a perfect name to own in the consumer discretionary space.
Monster Beverage outperform Morgan Stanley. Good entry point, they say, because the stocks had a pullback of 15%. Joe, you own that?
Yeah, I absolutely agree with that. I think you could add Coke and Pepsi into that conversation. Opportunity on the pullback. The concern has been margin pressure for the beverage names related to oil. Beverage industry in 2025 ran with 48.5 margins. You're looking at Coke at 61. You're looking at Monster at 56, Pepsi at 55. They could endure the margin pressure.
Yeah, they say the geopolitical risk is manageable. They look back through their history.
Certainly through
does
margins.
Morgan Stanley.
Yes.
Okay, Ecolab upgraded to overweight at JPM. You have that too?
Recent purchase for us. This is in the material space. I know Josh highlighted this. Forgive me for not knowing exactly. I think it might be on his best stocks in the market list. The stock has pulled back from where he bought it. They are participating in the cooling dynamic related to data centers. I don't think that's going away at all. The pullback really is more related to the material sector pullback that we witnessed in the month of March.
Sherry, investor?
We've owned this stock for many years, and they make rail cars and rapid transit equipment. One point they didn't make is that if you see fuel prices up at $100 or higher and you don't want to use as much fuel, use trains or metro systems.
I think does Farmer Jim own that, Wabtec?
He does.
Maybe,
yes,
yeah.
He does, right?
Yeah. We've talked about it
fits with his new
before,
book, I think, which drops today. Isn't it today? New book's out today. Speaking of subway cars, you go, Farmer Jim.
And submarines.
Now to Brandon. Well, his book is not exactly that, but sometimes the journalist misses. It's okay. Brandon Gomez, help.
Hey, Scott. Yeah, NASA announced today it will spend $20 billion to build a base on the moon. The agency is canceling plans to deploy a station in lunar orbit and will use its components to construct the base over the next 7 years. Now, an executive order signed by President Trump last year aims for the U.S. to land astronauts back on the moon by 2028 and begin building a permanent lunar outpost by 2030. And the White House is reportedly expected to announce that King Charles will visit Washington for a state visit next month in honor of the U.S.'s 250th birthday. Punchbowl News reports there will be a state dinner for the king, and he's expected to address a joint meeting of Congress. That would mark the first time a British royal has addressed lawmakers since Queen Elizabeth in 1991. And Gap is partnering with Google Gemini to allow shoppers to check out directly on the AI platform. It will be the first major fashion company to work with Gemini. Shoppers will check out with Google Pay, and Gap will handle logistics, including shipping. Scott, back to you.
All right, Brandon, thank you. Brandon Gomez up next, trading the financials fallout. Brian Belsky makes a new move in this year's worst performing sector. We will tell you what the name is when we come back. Let's talk some financials beyond private equity and private credit, because they're the worst sector so far this year. Now, obviously, they've been dragged into that whole conversation. You sold U.S. Bank Corp, a regional bank, a large super regional bank.
We did. A couple reasons why. You don't have to own everything, number one. Number two,
Okay.
our primary
Back to you,
theme-
or-
back to you, Scott. No, we really like the big ones and the really small ones in banks. In between have a scale problem. They can't compete with the big ones, and they can't compete with the relationship based on the small ones. So we sold U.S. Bank. It's got some issues with respect to wealth management. I don't like the BTIG acquisition. I work for Piper. We saw how that worked out. And so at the end of the day, we like PNC better for wealth management. We like Truist for their multi-line divisions in terms of line of businesses. We like Regions because they're in the right area of the country with respect to the Southeast. We like Pinnacle for the same reasons. And so, again, we don't want to own everything, and U.S. Bank is the casualty of that.
So Baird today has a note that says the group looks attractive following the recent weakness. They single out Fifth Third, Truist, Capital One, Synchrony, Huntington. What do you have out of that?
I have Capital One, I have Synchrony, which look absolutely awful on a momentum basis. Obviously, we are overweight financials, so we'd like to see that occur. We were sellers of U.S. Bank in the previous rebalance. To me, the focus right now for the financial sector is on the insurance companies, and it's on the exchanges. We own CME, we own IBKR. Both of those is pulled back. You have a nice point of reference here where I think you could buy them. SIBO, a name that I have owned in the past.
SIBO, good for you.
I think that is a name.
Good job.
I think that is a name that you could buy as well. And then if you think
Takes
about the
direction pretty well,
volatility,
don't you think?
If you think about the I'm just going to keep going. If you think about the volatility that currently exists in the marketplace, the one publicly traded market maker is Virtu Financial. Pull up a chart of Virtu Financial. It is approaching a one-year high. That stock's breaking out.
You made our executive producer very happy. 2 days in a row.
I do that on a daily basis.
2 days in
for
a row.
Everyone in my universe.
Look at you.
Most importantly, the viewers.
Okay. Shan, what about the banks here? Are they attractive following the recent weakness?
Well, I think if you're looking at regional banks in particular and you look at the multiples on the financial sector, there's an opportunity here. I think even some of the big banks are opportunities. And if you look at, we talked last week about Basel III Endgame and the potential for lower capital requirements. That will translate at some point, especially as we get rates to, which are likely to come back down over the course of the next couple of weeks. So I think that this is an opportunity to be selective, but you have a few areas of this sector to do that in.
What do you think?
Yeah, so I think in the case of some, such as American Express and Schwab, they got hit hard by the AI is going to replace every type of financial advisor. You're doing it all yourself. That was overdone, and those stocks have bounced from that.
Okay. We'll take a break, and when we come back, Mike Santoli. He's on the other side with his midday word. Senior markets commentator, Overtime co-anchor Michael Santoli joins us now with his midday word. As we look at this market today, I feel like yesterday morning's Truth Social post was a bit of a game changer. If in nothing else, it makes people think twice now about getting too negative. You just don't know what's around the corner.
No, it's a reminder that upside risk exists. I heard the litany kind of went through at the top about people kind of skeptical of this bounce. That is what the standard historical playbook tells you to be, which is, skeptical that this initial bounce didn't really clear any major hurdles. When the market goes down and damage is done to the longer-term trend, the burden of proof on the bulls goes up. I understand that, but 6,500 on the S&P is kind of a plausible place to think that maybe we have a floor unless we get incremental negative information or this negotiating idea is completely debunked in the near term, which I kind of doubt is the case. Now, the more time that WTI spends above 90 and Brent spends above like $95, maybe the more restrained the equity market rebound attempt is going to be. Also watching broader credit, private credit obviously is again kind of under pressure, but spreads have actually narrowed for corporate debt over as overall yields have gone up. That's been a pattern because people just like the absolute yields getting higher. So I don't know. I think it's an obvious holding pattern. We still have to make sure that you see some kind of demand come in as a rush, as opposed to just that kind of short covering and don't get too negative type of behavior we saw yesterday.
Market can probably deal with WTI a little above 90 for a bit, but once you start to get over the the $100 level, it just becomes incrementally more bearish, I would think, in people's minds for what the markets are going to do.
And of course, you have to watch the out months, how they're being priced. The reason I mentioned 90 and 95 is that's where it's kind of bounced on this run, and it's been sort of a support area. So if you actually spend a lot of time below that, it starts to feel like maybe it's breaking down and the rules are changing a little bit. But yes, there's no doubt. And look, I think that the White House has implicitly told you that $100 oil is also a pain point there, and maybe that catalyzes other action.
Yeah, no doubt about that. Michael, thank you. I'll see you on Closing Bell. That's Mike Santoli. Still ahead, we have many committee stocks on the move today. We will go through a handful of them next. Let's talk about some stocks on the move. Gilead is buying the biotech firm Aura, $2 billion. Right? You own the stock?
Yep. That's
Humility Capital owns it.
Humulus Investment Strategies. Thank you. HIS. Yeah, we own it. You know why? Because of this type of move. Lots of cash. This is what they're going to be doing, and they're going to continue to buy these little properties like this.
You like it?
I do. I like the fact that they are diversifying the product mix away from the antiviral drugs towards cancer, towards autoimmune, and they've really strengthened the balance sheet over the last couple of years, which has given them the ability to make some acquisitions.
Do you like the biotechs here or no?
Yeah, yes, I do. I mean, I own Amgen.
You think you do?
and-
You
Yeah.
do or you think you do?
Yes, I do.
You think you do?
I'm thinking about right.
Hold on, I'm going to give you a couple seconds to discuss it with yourself, and you can give us the answer. Hold on, she'll be right back.
Reconcile.
Yes, the answer is yes. Well, you know, they were all very cheap. Then they had a run up, and Gilead's moved up. But this is a good acquisition, and the stock's still inexpensive, but they used higher price stock.
Okay, I'm glad we got to the bottom
Thank
of that.
you.
Thermo Fisher, I'm coming right back to you, so I don't know if you need another discussion.
I'll let you know if I do.
They completed an almost $9 billion acquisition of Clario Holdings.
Yeah, it's another complement to their CRO business. That's an area they've decided to spend more of their capital. I think it's a good idea. Thermo's down 23% recently. The stock had a big run. Now it's down. It's selling at 18 times next 12 months earnings. So yes, I think it's a good opportunity for them, and the stock's attractive.
How about FedEx launching same-day delivery with OneRail? Trying to compete, I guess, more with Amazon and Walmart.
They're trying. You know, it's interesting about FedEx because they had a tougher year last year, and we added to our value portfolio because the industrial space was so expensive, and so FedEx, where valuations are, still make a lot of sense. We like the stock. We'd like it way more than UPS.
Okay. I guess that's all we got in that one.
Okay.
We'll take a break. We'll do final trades after this.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Three o'clock Eastern Time, closing bell, marathons. Bruce Richards will be right here at Post 9. We're talking private credit, obviously. Get his thoughts there. Alex Kantrowitz, you have the Anthropic trial today. OpenAI calling out Microsoft. There's a lot to chat about with big technologies. AK, he'll join us too. Liz Thomas, Bryn Talkington, Max Kettner. So we'll do all that 3 o'clock. We'll see what happens in this market as well. And we'll take you through that last and final and important hour. Brian Belsky, what do you got for your final trade, sir?
Costco, top 25 company in the world, should absolutely positively be part of any large cap core growth portfolio.
All right. Who's the discretionary?
That's me. We've seen oil price obviously weigh on discretionary stocks, but the higher middle income, higher income households remain engaged.
Okay. NextEra Energy.
Yeah, NextEra has had a bounce here, partially due to data center growth, but now maybe sustainability is no longer a bad word.
All righty, and Valero.
Yes, oil near the high for the day as we speak at 92.70, but it is reformulated gasoline and heating oil to pay attention to. That takes you to Valero.
All right, thanks everybody. I will see you on the bell. The exchange with Kelly begins now.
Thank you very much. And stocks are in a holding pattern, but yields are on the rise today. Welcome to the exchange. I'm Kelly Evans. The major averages are a little changed, although the Nasdaq down 0.5% is more considerable as strikes between Iran and Israel have resumed, and investors are trying to figure out how real the president's Iran talks are. That said, the S&P, with its 2-point drop today, is still tracking for its worst month in a year. And a rebound in energy prices has Brent back above 100 a barrel today and WTI back above 90. You just heard we're near session highs at 92 now, a 5% pop. The national average for gasoline has hit $3.98 a gallon per AAA. You can see yields as well. We're seeing some upward pressures here. 4.38 on the 10-year, 3.91 on the 2s. We'll have a 2-year auction in just a minute. And concerns about private credit are bubbling up as well, with Ares and Apollo seeing a spike in redemption requests. The stocks are paring their earlier losses, though. Ares is almost green, and our analyst will explain why he's staying bullish ahead. But let's begin with the very latest on Iran. We turn to Eamon Javers in Washington, and we may hear from the president in a little while, Eamon.
Kelly, that's right. We're going to hear from the president in about a half an hour. We're going to be watching carefully to see what he says about the prospect of any U.S. troops going to Iran. And that's because Fox News Channel is adding to New York Times reporting from yesterday on the Army's 82nd Airborne Division. Fox's Jennifer Griffin reporting this morning that the division's commander and his command element have been ordered to deploy to the Middle East. Now, that follows that reporting from the Times yesterday that said the Pentagon was considering deploying combat troops from the 82nd Airborne Division to the Middle East to augment the 31st Marine Expeditionary Unit, which is already on its way to the region. The Times reporting that combat forces would come from the 82nd Airborne's Immediate Response Force, which is designed to deploy very quickly around the world. Now, the White House not responding to a request for comment on that. Meanwhile, we see this Iranian official. He's taken to social media to mock what he sees as an effort to prop up the oil futures markets. The Speaker of the Iranian Parliament this morning writing, "We are aware of what is happening in the paper oil market, including the firms hired to influence oil futures. We also see the broader jawboning campaign, but let's see if they can turn that into actual fuel at the pump or maybe even print gas molecules." Now, all of this, as multiple reports suggest, several countries are working now to mediate talks between the United States and Iran, although there's no evidence yet of breakthroughs or scheduled in-person meetings. So all of that that in the air as we see the president come up at about 1:30 Eastern time here. He's going to do the swearing in for Mark Wayne Mullen, who's going to be the new head of DHS, but we'll also watch for comments on Iran, which, the president likes to go off script, so we could get those coming up in about a half an hour.
Absolutely. For now, Eamon, thanks very much, Eamon Javers. Our next guest says even if the war stops right now, the damage is done. Disruption to oil in the Strait of Hormuz, he says, will impact the economy for months still. Joining us from the CERAWeek conference in Houston is Jeff Curry. He's partner and chief strategy officer of Energy Pathways at Carlyle. Jeff, it's great to see you. And those two items that Eamon just mentioned, the Iranian official who says basically the U.S. is just manipulating or jawboning futures, and reports they're considering ground troops, all of which leaves you where on the oil price and on the energy complex from here?
Well, I think with the first point, one thing it's important to remember about oil, it is not a financial instrument. It does not price expectations. It is a spot instrument that has to clear today's supply and demand. So you really can't manipulate a commodity market. Yeah, you can push it down a little bit here and there, but the physical realities will be what dominates this market, and they're in front of us.
I like that point that you're making. You've talked about that a lot. And so the price today, which is on the rise, 92 for WTI, 100 for Brent. I don't know if we have a concrete sense of why that is, or if it's simply just gaming out, probabilities of whether additional strikes could happen on energy infrastructure.
Well, I think when we look at WTI and Brent, they're in the, WTI is the Western Hemisphere. I'm here in Texas and it's up there in Oklahoma. This part of the world will be the last part to feel these disruptions. The way you like to think about it is there's a finite buffer between when a disruption occurred and when you get physical disruptions. In places like Asia, that time period is like 2 to 3 days. So they're going to be hitting this within the week. In places like Philippines, it's already there. New Zealand, Australia, they're already feeling it. Jet fuel in some parts of the world is over $300 a barrel. So there's other parts of the world that are feeling it. In places like Europe, it's going to be within the next week or two. So I think the point here is the physical realities drive the physical price. And in oil, like Oman and stuff that's traded in Asia, is already trading $150, $160 a barrel. That's what's likely in store for places like Europe in the coming weeks. Now, WTI that's here in Oklahoma or up in Oklahoma, it's going to be the last one to feel it, and that's going to be way off in the future.
Still, you're talking about a much higher oil price, where I think a lot of folks have settled on this idea that we've put in the highs and are probably heading back down towards, I don't know the number, 90, 80, 70 a barrel. Do you think that's realistic?
No, absolutely not. And why? These are physical markets. They've priced the physical reality of supply and demand. That we have not seen peak physical strength in these markets or the shortages yet. So like a financial market prices the future, the expectations. It's why we call financial markets anticipatory assets. Commodities are what we call spot assets. They have to clear the supply and demand of today. There are no expectations. And so when that shortage hits, that's when you're going to see peak prices.
When you talk about shortages, I've heard this kind of going around that, watch out, come April 1st, we're going to start to see actual shortages in the market. Can you explain what you and others mean by that? Are we talking about in certain parts of the crude oil market globally, or are we talking about things that could affect, availability at the gasoline pump here in the U.S.?
Well, the way I like to think about it is there's an air pocket going through global supply chains of indeterminate length. It's getting bigger and bigger because we don't have new refueling supply coming out of the Gulf, so that air pocket gets bigger and bigger. Think about this. It takes somewhere around 3 to 4 weeks to sail a ship from the Gulf into Europe or the U.S., like Rotterdam, or into, let's say, the East Coast. So when you think about how long it takes from the time when the disruption started, take 4 weeks from when let's go somewhere early March, you're talking early April when you're going to feel it in places like Rotterdam and in the U.S. East Coast. Now, in terms of thinking about the U.S., because it is more insulated, meaning it produces what it consumes, it'll be the last to feel it. But it'll start when Europe starts to feel it. That's when the U.S. is going to start to feel it in the price level.
That said, we go back to the Russia war on Ukraine. When that broke out, it was 12 days after the start that the oil price peaked. So it's not as if that was 4 to 6 months later. It seems to be that the markets, even though they're spot markets like you're saying, I think financial market participants are thinking the worst of the pricing is over because of the quick nature of that response and that reality.
I think it's an important distinction between that event in Russia, Ukraine, and today. That did not lead to real physical disruptions because we saw the system adjust. The Russian exports didn't fall off a cliff and stay that way like people anticipated. And where there was one of those things, buy the rumor, sell the fact. And that's what happened. So people are looking at it, go, ha ha, you aren't going to trick me this time. They're not, they're buying the rumor and trying to sell the fact. But here, it's going to be one of those, you better start buying the fact. Because when that fact hits, it's going to be real shortage. Again, we're talking the biggest supply disruption the world's ever seen. I'm going to even quote Fatih Birol, who said, he's the head of the IEA, who said this is the biggest disruption of both 73 and 79 combined. So he himself says this thing's really big. You can't expect that this is not going to have a physical impact.
I was struck by that as well, because usually people like that are in the business of calming everyone down and saying there's not a crisis, and he was kind of playing it up the other way. And I don't know if there's an element of politics in that. I have no idea. What then, Jeff, can be done right now if we're sitting on kind of this, this tidal wave? It's like the water's gone out and we're about to see what's coming back on shore. What can be done in the interim?
Well, I think what they've done in the policy response is release the SPR. The problem is the flow rate is not matter. So you got that headline, 400 million barrels, but you can only get out like 1 million to 1.3 million barrels per day against call it a 15 to 20 million barrel per day shock in the U.S. Or when the U.S. is about 1.3, Europe is about another, bring it up to 2. So it's not going to do anything. There's no policy response that can really tame prices once the shortages get here. So yeah, we could be out selling the futures and trying to keep it down that way, but the physical market is what matters, and that's not going to have an impact on it. An important difference between futures markets and commodities markets versus financial markets. Stocks and bonds are long-only instruments. These markets are long-short. For every long, there has to be a short. And as a result, you cannot influence them by buying or selling like you can financial markets. And the reality is the physical market is really going to bite sometime in the next couple of weeks.
Do you think that if people, we'll leave it here, but do you think people who listen to this are going to panic and actually start stockpiling, even consumers perhaps, and worsen a problem that doesn't exist yet? Or do you think that that would actually be prudent or rational behavior on the part of businesses or other users of the products?
100%, you're right. That is going to be the reaction. Hoarding, precautionary inventory building, whatever you want to call it. I mean, the reason why China is protected right now, they've been hoarding for years, built up a huge stockpile in anticipation for an event like this. And that's what the SPR was created for, but we drew it down in 2022. And so when we look at consumers, I mean, you go back to the 70s, people were building fuel tanks in their backyards to be able to supply their automobiles. So this hoarding dynamic, it's underway. We estimate the impact on global demand is somewhere between 2 and 3 million barrels per day already in the current environment. That's almost entirely focused on hoarding. So yes, that in fact, I would argue that's when we talk about a security premium embedded in commodity prices, it's that hoarding dynamic that defines that security premium.
I see, understood. Jeff, really important time to have you on. Thanks so much for making the time. We really appreciate it.
Great.
Jeff Curry.
Thanks for having me.
From Carlisle, joining us there from CERAWeek. You might have seen the market taking a turn lower. We do have reports from the Wall Street Journal that the U.S. is sending 3,000 additional troops to the Gulf. No comment on putting boots on the ground, but Rick Santelli, that's it's not just your 2-year auction that is moving us around at this hour. And how did it go?
No, but it is partially the 2-year auction because it went terribly weak. Let's start at the beginning. 69 billion 2-year notes, the first of a 3-part offering from the Treasury, totaling 183 billion. This 69 billion moved out the door at a yield of 3.936. Those are 2-year notes. The problem was it tailed by about 2 basis points because the when issued market was at 3.918. And tailing is never good. D as in dog is the grade I gave it, and I might even be generous. If you look at the metrics, they're all quite weak. The bid to cover, meaning how many dollars of investment are chasing every dollar of securities available, was 2.44, or $2.44 for every dollar's worth of securities the Treasury is selling. That is the smallest, the weakest bid to cover since May of 24. And if you look at the direct bidders, they're about half of the 10 auction average, weakest since March of 25. But maybe the biggest thing that really is quite telling is that dealers on a 10 auction average usually take 11% of the auction. This time they took over 24%. That's the biggest primary dealer take part since October of 22, which means that the buffet table was so full of leftovers that the dealers had to scoop up twice the amount they normally do. Never a good sign. So usually the series of 2s, 5s, 7s, Kelly, goes really well. The shorter maturities are a little easier. But what's hanging on this one is the fact that the Fed and the timeline for easing has shrunk, almost moving into a potential for tightening. And that really makes it difficult to be owning 2-year notes. Back to you.
And we are up 13 basis points on the session, which is not the kind of action you want to see. No wonder the market taking it with a bit of trouble. Rick, thanks. Appreciate it, Rick Santelli.
Thank you.
All told, the S&P is now on track for its worst month in a year, but my next guest says the real story is that the indices are still only down 5% or less since Jan 1. Let's bring in Steve Sosnick. He's the chief strategist at Interactive Brokers here on set with me. Maybe forget it now that we've seen the 2-year and everything go, but what did the market internals tell you?
The market internals tell me that we still have this underlying bid. There's still this undercurrent of FOMO. There's still nobody who wants to miss a rally. And as a result, partially because, as Jeff Curry said earlier, that oil is not as bad as could be. We're not at the depths that we thought we might be. This has been the Persian Gulf situation is something that we've been modeling out, risk managers, and I was one for a long time. We're always gaming out what would happen if there was a closure of the Strait of Hormuz. And the gaming was $150 to $200 barrel oil and a minimum 10% correction in the S&P 500. Well, we haven't gotten those. And to that extent, maybe because oil's not as bad as it could be, at least not yet, according to him. Or maybe it's just because we've gotten so convinced that, every dip is a buying opportunity and every presidential move can be undone, shall we say, that nobody wants to be the one who wants, who's selling it out. And that's the dynamic.
Where do you see people kind of most excited to jump in and across kind of the markets broadly? Is it the favorite names we've talked about over the years? Is it sectors like software? I mean, where do you see activity? I hear more than ever about some of the new drone and AI defense companies and things like that.
There's always going to be a group of people looking for, sort of the sexy new company. And yeah, there was the drone company that went up, 11-fold in 2 days. That's a cool story. Where we see most of the activity, we still see people aggressively dip buying. Micron was the most active stock on our platform.
Wow, interesting.
Why? Because Micron
been such a great performer and had that pullback.
But exactly, it got the crap kicked out of it after earnings, and so people rushed in. One name that we do see a lot of people buying is VOO, which tells me that investors are active, that people are seeing this as a longer-term possibility.
And VOO is just the broad market. It's Vanguard S&P 500.
It is, but what happens, when SPY is active, that tells me traders are trading it, because SPY is more of a trading name. VOO is not as liquid. It doesn't have liquid options at all, but it's cheaper. So investors like VOO, traders like SPY.
And so you think this is a moment, and again, we were saying the worst month in about a year. Well, what happened a year ago? Look at the panic after the tariffs that the president put on. And again, look at what happened if you weren't coming in to buy at that moment. And I guess that's what people are conditioned to do here.
That's exactly it. People are conditioned to see every dip as a buying opportunity. What's the proverb? If you're a hammer, everything looks like a nail. And, to some extent, that was the case. And I wrote earlier this week about the Trump put. And on Friday, I wrote, what's the strike price on the Trump put? Yesterday, we learned that the strike price was either 6,500 on the S&P 500 or 445 on the 10-year. And I actually think it was more of a bond. It was almost more of a bond reaction because as a real estate guy who hangs around with other real estate guys, you're very tied into the borrowing costs. But as a result, I think that's why you saw the president say what he said both Friday afternoon and again yesterday morning, sort of to put in that level. But what happens here is this is a lot harder to undo than the tariffs. The tariffs were the stroke of a pen, and you could change them. In this case, you're dealing with global supplies of a commodity that take a long time to ship around the world and to get those price pressures through. And it's not just crude oil, it's liquefied natural gas, it's fertilizer, it's helium, which did you know? I didn't know until this. I had no idea that helium was so critical to semiconductor production. So there's all these factors of the supply chain that need to be worked through. So even if this thing resolves tonight, there's still going to be supply shock effects. Question is, if it ends quickly, you can call it transitory. And I know that's a dirty word when it comes to inflation, but you could think of it as transitory. The longer it lasts, the worse this becomes because they get more embedded in the system.
Quick last question then for the retail buyers. Are they going to be caught off sides if there is a longer lasting impact to energy and a more of a problem for the market in some fashion?
There is a real risk to it. And one of the basic things that I ask people is if you can't price safe assets like 2-year notes, as Rick Santelli just said, how are you expected to price riskier assets like stocks that base their prices on those shorter term assets?
It's an excellent place to leave it. Steve, thank you. Appreciate it. Steve
Thanks,
Sosnick
Kelly.
with Interactive Brokers. We've got a news alert on ARM Holdings. Christina Partsenevelis here with those details. Christina?
Well, Kelly, ARM is no longer just the blueprint company for making chips. After 35 years of licensing chip designs to everyone from Apple to Amazon, ARM is now making its own silicon for the first time. The company actually just unveiled its first in-house processor called the AGI chip with Meta as the lead customer. ARM says it delivers twice the performance of traditional server chips, which is really a direct hit at Intel and AMD while using the same amount of power. And this really comes as AI agents take on more complex tasks like reasoning and decision making, driving really a surge in demand for general purpose processors, CPUs. ARM says data centers could need more than 4 times the current capacity. Beyond Meta, ARM has signed other customers like OpenAI, Cerebras, Cloudflare, SAP, among others, with about 50 partners backing the launch. But it is a bold, although expected move that puts ARM indirect competition with the very customers it still licenses to include Intel, AMD, and Amazon. So it's entering the CPU race, which is growing.
Yeah.
Alibaba just announced a CPU chip today, too.
Amazing to watch how AI is really causing everyone to throw off their previous playbooks and just say we're all going at it, whether against each other or with each other or some combination thereof. Christina, thanks for now. Appreciate it. Christina Partsenevelis. Coming up, private credit concerns are back in the spotlight after Moody's slashed its rating on a KKR fund. Run by KKR and Future Standard, I should say. At the same time, Apollo is giving investors less than half of their requested withdrawals. What does it all mean for the health of the space? Plus, Databricks making its big debut, not in the public market yet, but in the cybersecurity space. And that's putting some pressure on shares of Palo Alto, CrowdStrike, and others. We'll talk to the CEO about that, and always going to keep asking him about that path toward an IPO. It's coming up on The Exchange.
This is The Exchange on CNBC.
the private credit market remains very murky. We've got all these investors that want to get out, and they can't get out.
That was Double Line's Jeffrey Gundlach warning of private credit strains here on CNBC yesterday afternoon. Not long after those comments, Apollo made news in its flagship $15 billion private credit fund by meeting just under half of the redemption requests from investors. Today, Ares also reporting about 11% of investors wanting their money back. Shares of both firms under pressure on the news, but off the lows. Moody's, meanwhile, cutting the rating on a private credit fund run by KKR and Standard Future to junk as bad loans grow. But my next guest is staying bullish. Let's bring in Crispin Love, Senior Research Analyst at Piper Sandler. Crispin, welcome. And you think, again, as we understand it, these 5% kind of gates exist for most of these funds as a feature, not as something that happens in times of stress. And you think, in a way, they should just leave the gates up, and maybe that will help quell the panic. We saw a little bit of this with the real estate piece a couple of years ago, different ways firms tried to deal with the spike in redemption requests. So I'd love to hear what you think would be the best move by most of these firms now.
Absolutely, and thank you for having me, Kelly. Yeah, we view the 5% cap on redemptions as balancing the interests of new, existing, and investors looking to redeem capital. We do understand that it can be a short-term hit for stocks, but it does help alternatives balance liquidity and put capital to work during times like these, when it is a period where it could lead to some very attractive investments.
You are bullish. Tell me, of all the companies, we've seen sell-offs between 40, 60%, I think, in the case of Blue Owl, in terms of the equity, the owners of some of these funds. Are you bullish across the board? Do you think the sell-off has created opportunity? Just talk through the investment case.
Absolutely. So we're somewhat balanced. I'd say our favorite name in the alt space right now is Apollo. Their focus is on credit, but 60% of their portfolio is investment grade. Software exposure is limited on the credit side. They have effectively zero software exposure in the private equity. And they also have their insurance business, which I think could be a stabilizer in this current environment, because I think wealth flows over the near term are going to be challenging, and it's not something that's going to improve tomorrow or even over kind of the next couple of months or perhaps even quarters. And then we also remain overweight on Blue Owl and KKR. We think just that the stock moves have given investors an attractive entry point, but it's not going to be a straight line. And then we have neutrals on Blackstone and Brookfield Asset Management in the space.
I was thinking about Blue Owl today because when going through some of their filings as this broke out, I believe, I could be wrong, that one of their big exposures was to Revolut, the UK fintech firm, which actually had some good news this morning. And so I'm wondering if your kind of case for owning exposure to these companies is predicated on the underlying assets performing well, or if they've fallen enough in value that even if the underlying defaults it, and you tell me whatever rate you have penciled in here, that that there's maybe still an investment case to be made.
Right, absolutely. I think it's on both ends. It's on value, and then it's on the fundamentals of the company. On credit quality right now, our view is that credit quality is not going to get better from where we are right now. Defaults are very low, kind of below 1%, and I think you're going to have one-off issues within the private credit space, but we don't view that as being systemic across the whole portfolio. When you're thinking about these types of companies, they're investing with kind of large cap companies, which have kind of plenty of EBITDA, and loan to values are typically in the 30 to 40%. So you have to look at, okay, in order for the private credit firms to take losses, private equity needs to get completely wiped out.
Right.
And then to your point on Revolut and just other areas that can help, I think digital infrastructure and data centers are a big part of these stories, where it's not just private credit to middle market firms, but you do have digital infrastructure, which is going to be a tailwind for years to come.
Yeah, and so do you think it's to some extent an open story? And the Wells Fargo guest we had on, Morgan Stanley Investment Management yesterday on Power Lunch, he said they've had institutional clients who are buying into some of these firms, even as retail is panicking and leaving. So not to call it smart money or anything like that, but do you see similar inflows to some of these areas?
Yes, and it's interesting, when you look at 2025 results, fundraising was extremely strong across institutional and also in the wealth channel. And yes, of course, right now you're seeing wealth step back a bit, but even with Apollo's news last night, where they had effectively 725 million of gross inflows into the product. They had requested redemptions of 1.6 billion, of which they will redeem right around 730 million or so. So net flows in the wealth products right now are relatively stable. It's not just capital going out the door.
Yeah.
And then on the institutional side, I think you're going to continue to see fundraising in those types of areas.
It's fascinating. And Crispin, we think you have a great name. I mean, this is either, if they ever, I hear The Bachelor. No, anyway, a pleasure. Not only that, but you can break this down in an understandable way. So I really appreciate the time this afternoon. Thanks.
Great.
Crispin
Kelly,
Love
thank you for having me.
of Piper Sandler. Coming up, we're about 3 hours away from the start of a high-stakes hearing between Anthropic and the Pentagon. We'll get a live report outside the courthouse ahead. Stay with us on The Exchange. Welcome back, and take a look at the markets where we're seeing a move again. A little bit of weakening after the past few items of news flow. You could say it's the 2-year auction that Rick gave a D. These headlines from the Wall Street Journal that the U.S. is still considering deploying troops, I should say, to the Middle East. The Dow is about unchanged. The S&P is down 0.25% right now. The Nasdaq's down 0.8. The small caps, for what it's worth, are fractionally higher. And take a look at some of the stablecoin names where Circle and Coinbase are seeing big drops, with Circle down 22%, its worst day since going public last June. It comes after industry insiders apparently saw a draft of the U.S. Clarity Act. The legislation essentially would bar rewards on passive stablecoin balances and ban structures economically equivalent to interest. Mizuho analyst Dan Dolev saying that could reduce the use case for Circle in the near term and make holding stablecoins on Coinbase's platform less attractive in the long run, which explains why these names are under such pressure. And we'll wait to see any more clarity on that front. Let's get to Leslie Picker in the meantime for the CNBC News Update. Hi, Leslie.
Hi, Kelly. Afghanistan's Taliban today released American academic Dennis Coyle, who's been held since January 2025. The foreign ministry saying Coyle was released after a letter of appeal from his family and that he would be pardoned for Eid, the holiday marking the end of Ramadan. Coyle was detained on allegations of violating laws, but Afghan authorities never publicly stated what those laws were. Delta Airlines is suspending its standalone service for members of Congress until the TSA is fully funded. In a statement to the Atlanta Journal-Constitution, Delta says taking care of its people and customers is becoming increasingly difficult during the shutdown. Last week, Delta's CEO told CNBC that TSA working without pay is inexcusable. And Epic Games says it will cut more than 1,000 jobs after a drop in usage for its flagship game Fortnite. CEO Tim Sweeney told employees that the cuts and savings from lower contracting and marketing spending will put the company in a more stable place. Sweeney says the layoffs are not related to AI.
Interesting. All right, Leslie, thank you. Coming up, the cybersecurity names are under pressure today after Databricks announced it's entering the market. We're going to ask CEO Ali Ghodsi about that move right after this. Databricks, one of the most valuable private companies in the world, making a big move today, entering the cybersecurity market and making its first move into first-party apps. Deirdre Bose is at the RSAC conference in San Francisco with Databricks CEO Ali Ghodsi. Deirdre?
Kelly, thank you very much. And Ali, thank you so much for being here with us right off your keynote. I look around, we've got Splunk, CrowdStrike, Palo Alto on the floor of RSAC this year. You are now entering the cybersecurity market. They have decades of expertise, thousands of people who specialize in cybersecurity. Why do you think that Databricks can take them on?
Yeah, I think there's a big secular shift happening now. And I really think AI is going to kill the SIM this year. I think this is the year AI kills the SIM, the security.
What's a SIM?
A SIM is a security information event management system that does all of your detections in your organization. It detects if something is wrong, if something is suspicious, and all of that. This is the year where it's going to be disrupted. These old legacy systems are very expensive. Getting data into them is super hard. People are not even looking at all the data. And then on top of it, lots of manual labor. Security teams are waking up every day and they're having thousands of alerts and just can't go through them. And then on the other side, the attackers are getting more and more sophisticated and just using agents to attack these systems, no longer even humans. So 2-3 years ago, it would take something like, 3-4 months from the time a vulnerability was found until someone exploited it. That is now down to 1 day. So it's not even humans anymore attacking these systems. So we need a new approach, and the new approach is open. So all your data in an open lakehouse, and then unleash all the agents, open agents that you compose on top of that, so that we're fighting agents with agents instead of fighting agents with humans.
And critically, something you have that they don't necessarily have is the data already. You have the data lakes, which is why I believe you're able to make this more cheaper, right? Lower costs. You say you're going to cut it by some 80%. What happens to these legacy players who you're also partnering with?
Yeah. Well, I think that, they will adapt. Everyone will adapt to the new model. I think the SIM goes away. I think this security lakehouse, this open security lakehouse becomes the next way in which you actually defend. And we also launched an ecosystem for that reason. We call it the Open Security Lakehouse ecosystem. And we have many partners as part of that. But I think this is going to be the way of the future. If we don't do it this way, I think many organizations will actually crumble because there's so much attacks coming.
So it feels like cybersecurity is just the beginning, considering how much data you're sitting on, and you said yourself that you are going to be part of the software disruption. What does that mean? What's next?
Well, what do you need for this new era, this agentic era? Well, you need a platform where you can build agents. Databricks has that. You still need a database for system of record. We have that as well. That's Lakebase that we launched. That's our transactional database that we launched last year. And then you need a data platform where you can have all of your data. So we have the 3 ingredients that you need essentially for any SaaS application. So, for us, those SaaS applications that make sense, and we're starting here with SIM, we want to build them and we want to go for it. Yes, this disruption will happen, and I think we will be part of that as well. We will partake in it.
So what do you tell? You have tens of thousands of customers. You have lots of software customers as well. How do you make this not threatening for them? How do you convince them to stay on your platform, keep giving you their data when you could turn around and compete with them?
I think that this disruption is going to happen anyway. It's like, there's no way we can stop time or stop this from happening. It's just bound to happen. We're going to have agentic software. That's the new interface. We're going to have databases that are built for agents. That's what we call it Lakebase at Databricks. And you need a data platform. Data is the most important. And by the way, you need governance in the middle that actually secures all of that. Because otherwise, you can't just let your agents loose and they're accessing salary data and sensitive data and exfiltrating stuff. So you need good governance as well. This is going to happen anyway. So, I think the world will adapt to this new world. If we don't do it, others will do it. Right. We will try to be as partner-friendly and do it in an open way and work with our partners as much as we can.
But it's going to happen anyways, as you said. Last time we spoke, I think it was about a month, maybe 6 weeks ago, you had just raised $7 billion. I asked you why. You said that some of your investors, and yourself included, were feeling a little bit nervous. You were seeing some bubbly behavior in the AI trade. How do you feel now, and how does that make you think about an eventual IPO?
Well, I feel really good. I think our timing was perfect. We raised money exactly just before, this meltdown is happening. Now, we thought, frankly speaking, that the meltdown would be on the AI side, but it's now instead that anything the AI companies do, just decimates anything in software. Actually, frankly, anything in tech, it seems. But
when you say meltdown, what are you referring to?
Well, I'm saying look at the stock market. Just down so much. And you might say, who cares about stock prices? Software, anything in technology is down, right? And what does that mean? Well, it means that those companies, their employees are getting paid less. And by the way, there's this pressure now that SBC needs to be reduced, stock-based compensation. Well, so then that makes it really hard for all of these companies, and they have to start cutting, and they have to get more efficient. So it's a perfect time to be private, I think.
Couldn't it be a perfect time to go public if you're showing the opposite? I know that you guys are already free cash flow positive, and I'm assuming you haven't overhired, or maybe you have?
I think there's too much volatility this year in so many ways. And, so I think the 2 years that are the best to be private are 2022, in the last half a decade, and then now is the best time to build for that AI future.
Okay, building in private. You'll continue to do so. Ali, thank you so much for chatting with us. Kelly, I'm going to toss it back over to you in Englewood Cliffs.
IPO, just do it. It's going to be fine. I teased Ali about that. Thank you, Ali Ghodsi and Deirdre Bosa. Really appreciate it. Coming up, Anthropic is the first American company to be deemed a supply chain risk by the Pentagon, a decision that a group of high-ranking former military personnel, including secretaries of the Navy and Air Force, say could ultimately hurt military readiness. Anthropic and the DoD will meet in court for the first time in less than 3 hours. We'll get a live report next.
As America celebrates its 250th anniversary, CNBC spotlights the companies that rose with the nation and continue to shape its future.
I'm Karen Kohlberg, CEO of King Arthur Baking Company, which has been around since 1790 and is America's oldest baking company. King Arthur was founded over 200 years ago. And I always like to think of what the country was like at that time. There were 13 states. George Washington was our first president. And our founding family at that point said, we need flour for people to bake. Flour was a cornerstone of the kitchen, and having incredibly high quality flour was important so that people could sustain their families. When I think back over 250 years, it's our values that guide us. They are foundational. They are our commitment to quality, a commitment to our communities, and it's stewardship. We became 100% employee-owned in 2004, and it is very much a defining aspect of who we are. We rebranded from King Arthur Flour to King Arthur Baking Company in 2020. We knew that we needed to modernize. We knew that we needed to be setting up the company for the next 50, 100, 250 years. And we wanted the name to reflect that we can innovate beyond flour. Education and teaching people how to bake is a core part of what has made us success and made our company endure over centuries. Whether it was putting recipes in an ad years ago, or in today's world, offering on-demand baking classes so that people can learn how to bake. When I think about King Arthur growing alongside America, I think about resilience. I think about the importance of knowing what you're about, knowing what you're trying to accomplish, and knowing who you are.
We are just a few hours away from the first decision in what could be a protracted legal battle between Anthropic and the Department of Defense. Mackenzie Sagalos is in San Francisco, outside the courthouse, with the latest on that story. Hi, Mackenzie.
Hey, Kelly. So this is the first time a judge will weigh in on the standoff between Anthropic and the Trump administration. Today's hearing is about Anthropic's request that a judge block two things until the case concludes. The Pentagon's supply chain risk designation, which effectively blacklisted the company from all federal business, and President Trump's directive ordering the government to stop using Claude. Now, Anthropic argues that's retaliation for exercising its right to protected speech. The DOJ framing this as an operational security issue, saying Anthropic poses a risk because it retains privileged access to Claude and could theoretically tamper with or shut off the model during military operations. But on Monday, the judge tipped her hand a bit, sending both sides a list of questions that she wants answered, including what evidence actually shows Anthropic had ongoing access or control over Claude after delivering it to the government. Now, support for Anthropic has been broad. Microsoft filed an amicus brief, while roughly 150 former judges and even employees from OpenAI and Google have backed the company, calling this government overreach. And Anthropic is fighting this on two legal fronts, here in California on First Amendment grounds, and then in D.C. arguing that the Pentagon misused a law meant for foreign adversaries. Both cases, though, they aim to strip that label before the damage is permanent.
Listen, the stakes are very, very high. We look forward to hearing more about it. And Mac, I think I would have done better in calculus, by the way, if you were my teacher in high school. It was a rough time. And anyway, we'll talk offline. But appreciate it very much. And congrats, Mackenzie Sagalos. Coming up, it's been a rough month for U.S. markets, with the S&P down nearly 5% just in March. It's been a lot worse overseas, though. South Korea's high-flying Kospi down 11%. European stocks down more than 8%. But as the Iran war continues, should you be bargain hunting overseas or staying closer to home? We'll discuss that when the exchange comes right back. Welcome back. The U.S. and Israel waging a war against Iran, while other international markets are feeling the most pain about it as concerns about energy costs and supplies persist. In Europe, we're talking about 9 and 10% drops this month. Japan's Nikkei, Korea's Kospi are down 11%, and the Hang Seng is the relative outperformer with about a 5% drop. But do all of these dips provide entry points for a larger narrative that might reassert itself if this conflict can pass? Let's bring in Tim Seymour of Seymour Asset Management. He's also a CNBC contributor. And Tim, it was interesting. One of the flips that's happened over the past few weeks is people saying, hey, maybe it is time to look at U.S. stocks again. I think I know how you feel about this, but I am just curious as this goes on if your thinking might change.
Well, what I always try to do, Kelly, here, first of all, great to be here, and establish that while I run an international ETF, IDEVO, and I've been investing internationally for 30 years, I have to be real about trends in history. And as someone that's invested in other parts of the world for a long time, I mean, there's supply shocks, for example, really hit current account countries and hit the FX a lot harder. It doesn't come back right away. So the big picture trends and themes that you set the table on, I think, are real. But I don't expect necessarily that this is going to be a flip the switch and foreign investors who were overweight U.S. Flow immediately back into the 10-year historical average of where they were, which was 25 to 30% U.S. and not 50%. And U.S. investors who are absolutely underweight international. It's hard to argue. We could talk about U.S. equities. We could talk about international. I mean, there's an argument that mega cap tech in U.S. looks kind of interesting here. But the setup for international is very good, and it's actually been resilient for the last 3 weeks once after the war kind of headlines hit.
Yeah, and I see that you're Denny. They were a big part of this too, saying go international kind of before the turn of the year, and they're saying we stick with it. We think that's good, going to reassert itself. I am curious, and again, it's not like people are forced. You don't have to do just international if you wanted to do, a little bit of everything like we do in the markets. Right. What is interesting to you about big cap tech in the U.S.? Because is that a move that's now mature and passé, even though it's very short, just last 3-4 weeks, or why is that interesting to you?
Well, I think, for example, even the headlines with ARM and Meta today show that there is some flexibility. Yes, there's CapEx being spent, but I think if you look at companies like Meta or even Microsoft, Broadcom, you're talking about PEG ratios, so price to earnings growth of under 2. Wow. They've gotten really attractive on forward multiples. I mean, Microsoft did 21 times. We know what's going on in software. But you can't tell me that there's also not flexibility in the CapEx and in the free cash flow dynamics. And we know that there's a secular growth story. And every day we wage war, we are taking longer to get back to at least some of those EPS trends that started the year when universally the strategists of the world said we were going a lot higher. So I just think you have secular growth that's hard to dispute, and that should be defensive here. And these companies were selling off for a year. We could push back, but the bottom line is I think U.S. mega cap tech is interesting here, but it doesn't mean you shouldn't be looking internationally.
It's very interesting. We don't have a lot of time, Tim, but quickly, just how is where are you on metals, on energy? Is that both areas people should lean into, or TBD?
Gold is still a safe haven. Make no mistake. And in fact, the gold investors that were there for the FOMO of maybe left, maybe they haven't. But the reality is, I like precious metals, but I do think copper demand continues to have also natural supply kind of demand imbalances. And yes, I do think you're going to continue to see energy prices keep moving higher.
All right, Tim Seymour,
Thanks,
appreciate it. Great to see you this afternoon. We'll leave it there with Seymour Asset Management. That's it for us. Thanks for tuning in to The Exchange, and I'll join you for Power Lunch with a whole lot more right after this break. Welcome back. In the broad markets are under some pressure, giving back the sharp gains we saw yesterday as crude prices are rising and the Iran war moves further into its fourth week. Tensions escalating with the U.S. reportedly deploying 3,000 airborne soldiers now. That's the latest headline on the tape. Welcome to Power Lunch. This isn't Brian. This is Hightower's chief investment strategist and CNBC contributor Stephanie Lake. Really pleased to have you here, Steph. A lot to get through. Brian is on assignment and will be with us later this hour from CERA Week in Houston. The big lineup of guests. We'll hear from ConocoPhillips CEO Ryan Lance, GE Vernova CEO Scott Strazik, and Brad Smith, who is president and vice chair of Microsoft. We have a lot of show to get to, so let's get started. Kick things off talking through these markets. Stocks are broadly lower today as Brent is climbing back above 100. 103 is the print right now. We're seeing about 3-4% gains in both WTI and Brent. Wall Street trying to factor in a bunch of different risks from the war in the Middle East, concerns about private credit, AI disruption fears in software. You can see the S&P down about 0.1%, 0.2% decline in the NASDAQ. It's not deterring Barclays from raising its year-end price target, though, for the S&P to 76.50 from 7,400. And they're raising their earnings forecast to 321 from 305 a share. In fact, joining us now is Vinu Krishna, Barclays U.S. equity strategist who made those calls. Also here on set with us is Marianne Bartels, chief investment strategist at Sanctuary Wealth. Really, really great to have everybody here. Vinu, are we wrong about this? You look at everything going on and say, let's raise the price target. Talk about why.
So I'm saying I'm tone deaf.
Or the earnings are leading the way. I mean, this is what we were just talking about. The estimates for the quarter and for the year have been going up even in spite of the Iran war.
Right. I think so. There are a couple of things. The macro uncertainty is there. We fully recognize it. And we recognize that the left tail is fatter now than it was 3 months ago. And that's why our downside scenario is significantly more than the upside you're going to get. But that said, if you take a step back, earnings momentum over the last 2 quarters especially, the solid earnings we saw in fourth quarter, the revisions upwards.
Was it 13% in the fourth quarter, or am I imagining that? Was it something to that effect?
14%.
14?
Yeah.
Wow.
And for the full year also, for last year, we are clocking close to 15% growth compared to 24. And then most importantly, the engine for earnings growth in the US has been tech broadly. And the way we define tech, it's close to 45% of the market. And there, the numbers are going up even faster, including mega cap tech.
And everyone's been saying, it's too top heavy and it's broadening. I guess it doesn't matter as long as the big part of the market you think is going to do well then.
And that big tech component, which accounts for a third of S&P profits, has been derating for the last 6 months. So we are sitting here with their multiples, forward multiples, 7 handles lower than where we were a year ago, roughly. Earnings, which are still posting more than 30% as of last quarter.
It's crazy.
So these numbers are very compelling. And we think that if that direction goes, what you do care about in that group, for example, is the rate of earnings growth significantly higher than rate at which the multiple is compressing.
Yeah.
And the multiple is compressing simply because the free cash flow yield is falling as the capital spending has increased quite substantially. And these companies are seeing it as an investment. The market is uncertain whether or not this becomes a permanently more capital-intensive business.
All right, so Marianne, jump in here. And how are you thinking, given everything that we've learned in the past few weeks, does this case make sense to you? Or, if you should have heard Jeff Curry an hour ago talking about the fact that the physical, the oils market is not yet pricing the shortages that may be coming, that the price could be going higher. That's obviously going to mean, look at the action today if that's a taste of that. So I'm just curious how to bring this all together.
So I do think that the economy is percolating. There's really good things going on in the economy. We're coming into this Iran conflict with strength. The consumer's actually been strong. Based on Bank of America's data, the consumer is the best in terms of spending in the past 2 years. But we're in a risk-off mode. And as long as we're in a risk-off mode, markets are going to remain volatile. And this time it's a little bit different because it's not just the public markets that are risk-off. We have risk-off in the private markets as well.
True. It's not helping.
And until we can get confirmation that we're moving in the right direction in Iran, markets are going to have a hard time actually rallying. I don't think they'll be able to sustain a rally until we have confirmation of the direction.
It's one of those statements that is self-evident but remains a stubborn fact. And so I don't know what, maybe Steph, you can jump in here too. What do investors do about that? What we could hear from the president in a few minutes could move us 1%, 2% up and down in any direction, and that's true now. It could be true with any message. It could be true tomorrow morning. So
I think though both of these guys, Gal, I'm in the same camp in terms of the economy is hanging in. The economy is a heck of a lot better than just where we were at Liberation Day, right? And look what happened if you sold on Liberation Day, you missed 35% rally off the lows. Same thing with Silicon Valley Bank in 2023, same thing in COVID. So I, as a portfolio manager, I love that we're growing, 2% in GDP? That's the Atlanta Fed tracker. That actually should equate to something like 8 to 10% earnings growth. Some sectors more, some sectors less. But the sectors that I like are the sectors beyond tech, because those have gotten beaten down much more than the overall market. Cal, if I would have told you we have dealt with Venezuela, SCOTUS reversal of tariffs, AI, software, private credit, and now a war we have no idea the timing about. And by the way, the S&P is only down 4%, and the equal weight is flat.
Is it really? Because that's the wall people always talk about. In retrospect, you go, oh, but those problems were quaint. We all go, oh, Silicon Valley. But at the time, we thought it could have been another, bank run. At the time, any of these items look so large.
And in fact, that's what makes me feel very confident about the banking system, because of the regulation and the excess capital that these companies have had to have since 2008. Silicon Valley Bank was a blip, right? And so I think it's all about timing, right, of this war, once we get through it. But if we wait for certainty, I think we're going to miss a lot of good ideas and a lot of good buys.
Feel free to rattle them off as I ask you about the one other area, too. We've talked a little bit about the private markets. And is there something opportunistic as an investor to do? Here's the challenge I get my head around. If people say, look, the private credit problems, they're both, higher on the capital stack, that's fine. And also kind of depend on what happens with software. So does that mean that private equity should be marked down here because they have some of their own concerns between high rates and the quality of some of the underlying and what's going on? Is that an opportunity for those, if you take the long view to say, of course, you'd want to pick up a name like a, fill in the blank blue chip company at 40% off? I don't know if you do something there.
I don't know what your proof point is in the short term, but I think long term these companies are very diversified, right? And you definitely have the great managers and then not so great managers. And we had fraud as well, so that we had to contend with. It's not all fraud. So I do think, I like what JP Morgan's doing in terms of marking it down. Maybe some other banks have to, but the big banks, the big six, they are so diversified. And Bank of America at RBC's conference, 2 or 3 weeks ago, talked about all good things, reiterating a lot of what you all said in terms of the consumer, but then also NII growth, M&A, capital markets, and they're flush with cash. The big six have $176 billion in excess capital right now. And that after the GSIB rules last week and the Basel III, they're going to have about $220 billion to lend, which we want them to do, and also to return it to shareholders. And they're trading at like 1.2, 1.5 times book. They're not super expensive, and some of the regionals are below book.
And so, Vinu, before we go back down to Houston or hear more specific, is energy and what some argue that we're going to see this big shift really in capital moving from tech to energy. Do you have a point of view on that, or the way that people should be? We mentioned that the market cap that tech is right now. Stephanie mentioned the performance of the equal weight. Is there something to do there?
So one, with Stephanie, I agree on financials. So we've been wrong thus far, but we certainly think it's all in the price. On energy, it's a little bit more dicey, because coming into this whole crisis, their earnings trajectory was not good. In fact, it is one of the biggest detractors of the forward guidance, which is going up, which tells you that fundamentally, energy was not in a great place. And from a physical standpoint, we were dealing with excess capacity in the oil market. All that has changed overnight because of the war. And the reality now is the war has taken a shape in which the supply constraint may linger for much longer. And energy security becomes, again, a bigger issue. And the Strait of Hormuz, when it returns to normalcy, is pretty much unknown. So I feel that even though fundamentally I still hold that view that energy probably is more than pricing in pretty aggressive oil price deck at this point in time, which is far greater than where the oil strip is, the forward curve right now. But I think we went neutral on it. So from negative, we've gone to neutral, recognizing that this war casts a different shadow and you can't fight that aspect to it.
Marianne,
that's our view on it.
last comment here, same question.
I disagree. I think energy's in a new leadership position. Now, the sector's the best performing. It's up over 30%. I do expect that sometime you're going to get a pullback. When all this gets resolved and energy comes down, you are going to get a correction, but I think these are going to be great buying opportunities. I think we're going to hear a lot about energy companies over the next 3 to 5 years. So it's one of the sectors I'm most bullish on.
Well, let's hear from them right now. Thank you both. Really appreciate it. Vinu Krishna from Barclays, Marianne Bartels of Sanctuary Wealth. And as oil prices are moving higher again today, Brent is at 103 or so last check, WTI at 92, natural gas. I mean, look. We're glad it's not higher. One company watching every twist and turn in the Middle East is ConocoPhillips. Brian Sullivan does bring us a CNBC exclusive with Chairman and CEO Ryan Lance. Hi, Brian.
Hey, Kelly, thank you very much. Yeah, we are joined by Chairman and CEO Ryan Lance, and I know we are also waiting for President Trump to start speaking, so I'm just going to blast this out. Right. Ryan, thank you very much.
Thank you, Brian.
Any impact, obviously the price of oil, $92 a barrel, any direct impact on ConocoPhillips from the war on Iran?
Well, we're a big partner with the Qataris in the Ras Laffan, the big LNG projects that are supplying LNG to around the world, so we're a significant partner in that asset, and yes, that whole complex has been shut down as a result of this. So 20% of the world's LNG is not now flowing to the world because of the shutdown in the Straits of Hormuz.
Is that a financial impact for ConocoPhillips?
Well, sure. I mean, the revenue's not flowing as the production doesn't flow, but obviously it is an impact, but it's one that's manageable in a big, diverse company like ours. Only represents about 2 to 3% of our company's production and cash flow.
Yeah, it's the world's largest single natural gas facility. So outside of the financial impacts on you said it was small, 2 to 3%. What do you see? This could be a 3 to 5 year offline. You're coming online with LNG next year here in the United States. What do you see as a short and longer term impact on the energy supply chain from this?
Well, I think what everybody was concerned about 1 month ago was that there were headwinds to the LNG business because it was going to be oversupplied in the next couple of years. That has certainly turned into a tailwind as a result of some of the actions and taking 20% of this LNG off the market, and that's not replaceable. So we'll see fuel switching in the short term to other forms of energy, oil and coal, and to where they can nuclear and some of those things. So I think the medium-term impact is we're going to see elevated prices as a result of this. All what we can hope is we get back to some normal situation, get these facilities online as quickly as when, so we can reestablish that equilibrium in the world.
But I want to be, we had $65 oil a month ago. We had natural gas here is about the same. It's much different overseas. So it's only been a month.
Right.
We're all hoping for a swift outcome to whatever occurs. Any change for ConocoPhillips's plans and capital spending plans based on the current price of oil, or would you need elevated oil and gas prices for months, quarters, or years to make a real change on your spending plan?
Well, I think our assessment was you have to see a new equilibrium in mid-cycle price over the long haul to get us to really fundamentally change our plans. We've got a pretty resource-rich company right now. We've got ability and options to invest into the portfolio, starting with the U.S. Lower 48. We're growing that business already today, but if we see a long-term call for crude that results in a higher price, absolutely we'll be leaning into the opportunities that we have in our portfolio to invest to grow and develop our company.
But how long, Ryan, would it take for oil prices to remain elevated, maybe this level, maybe higher, maybe a little lower, for you to say, okay, let's change our plans and invest more in the United States because now we just have more excess capital?
Yeah, well, I think if you see that developing and you feel comfortable that's going to persist for a year or two, absolutely you're going to go into that. 2026 is already laid. We made those plans at the end of last year. There's not much we can do to impact 2026 production, but if we see a better call on crude and more elevated prices, then absolutely we'll be reacting this year as we go into 27 and 28 and beyond.
The president said yesterday that when the war ends, oil will drop like a rock. And it was down 12% at the time that he said it already is, but it's not back to 65. Does Ryan Lance think that the war ends tomorrow or next week or next month back to 65 right away?
Well, I think it's really tough. We're all trying to assess that today. What is the new mid-cycle price? I think what we can say reasonably, the floor has risen up a little bit. And I don't know if that's risen from 60 to 65 to 70 or 75, but I think the floor has come up a little bit. And you have
fundamentals or risk premium?
I think both. I think fundamentals are going to be that all the inventory is going to be drawn as a result of how long this the war lasts, the floating inventory, the onshore. So we'll have to replenish inventories on the back end of this. But there has been some structural things that have happened as well. Like you said, facilities that have been hurt and not the ability to produce oil, generate the product. So some of that's going to take some time to rebuild. So the whole system has to recalibrate. That is going to take some time, which I think raises the floor on the bottom side of prices. You can argue $5 or $10 or what that does. And the real question is, what's the trajectory beyond that? And we've been pretty constructive even before this engagement of this war in the Middle East. I think it gives us more confidence that the price is probably going to be higher 3, 4, 5 years from now.
Okay. You've got a huge refining business getting bigger with the Marathon deal. Right now, at this price point for retail gasoline, are you seeing any demand destruction in the American economy?
Yeah, so we're an upstream company only. We're no longer integrated, but we are seeing a little bit of changing behavior in the consumer. So,
like what?
Well, I think the real key is as we come into the summer months and we see what happens in the gasoline price, the reformulation that the president announced, try to get rid of the summer blend and try to help that is going to help. But yeah, we're all watching that pretty closely to kind of see what happens is there demand destruction, not only in the product space, but also in the oil space as well.
You and I have talked at this conference for years and really appreciate you sitting down, by the way. It means a lot, Ryan.
Yeah.
That we're seeing this sort of push-pull with the administration, which is we want the administration wants lower oil and gasoline prices for the affordability. But there's a level at which your industry is going to say, listen, it's fine, but we're not going to invest any more in grow production because we're not going to lose money on every barrel. Is there a happy medium somewhere in there between prices, growth, and affordability for the American?
Yeah, I think there absolutely is. I mean, I think we were kind of establishing that in the kind of mid-$60 to $70 range for oil prices. It was certainly enough for companies like ours with a really good, strong portfolio, low-cost supply, that we could invest a reasonable amount of our capital back into the company for growth and development, but also give a reasonable amount back to the shareholder. So it's really balanced. It's really trying to get some consistency built in and try to tampen the volatility that is naturally in our business. That gives us more concern, more ability to invest in some of the long-range projects like we're doing in LNG, like we're doing in Alaska. It gives us more confidence to do that when we see that trajectory over the longer term, and that's what's important, and dampen out the spikes, the peaks and the valleys.
So you mentioned Alaska.
Yeah.
You are, I believe, the biggest operator.
We are
up there. I was up there less than a year ago to your shop. Met some of the great men and women that are putting in hard work up. I mean, that's 2 weeks on, 2 weeks off. That's a different life.
And it's the middle of the winter still.
Yeah, it felt. I was there in June. It was -7 in the morning. It felt like winter. Exxon and Shell both kind of maybe thinking about coming back into Alaska. You've been there forever. Yesterday, Secretary of Interior Doug Burgum told us on air he was confident that the Alaska LNG pipeline was going to be built.
Yeah, we're hoping.
Are you as confident?
I think it's got some hurdles to do. I think they've made a lot of progress.
Well, $44 billion is a pretty big hurdle.
Yeah, and probably that may be a light estimate too, but we'll see. But they made a lot of progress. We have a lot of gas and gas production, and we've demonstrated our ability and our willingness to make the investments that we'd have to make that gas available for a project at LNG. I've worked on that project 4 times over the last 40 years, and I think it is as close as it's ever been to realizing a maturity and actually getting a project in place.
And then very quickly, finally, so if we see other majors go back to Alaska where you've been for a long time, Exxon's up there in a way too, but if they come back in a bigger way, is that a good thing?
Oh, absolutely.
For ConocoPhillips?
I think it's a good thing for the competition. It's a good thing for Alaska. We welcome more people to put more oil into the infrastructure that's already been built in Alaska. So we welcome our partners and our competitors back again to the great state of Alaska.
And a very different way of life up top. Mile Zero, I saw at the Alaska pipeline.
That's
amazing place to be. Ryan Lance, Chair and CEO of ConocoPhillips. Really appreciate your time today. Ryan, thank you.
Thank you, Brian.
Thank you. Kelly.
Brian and Ryan, thanks. And we're going to take a quick break. More Power Lunch, possibly hearing from the president. Dow's down 33 points. We're back right after this. The conflict in Iran is not the only major story that's dominating the conversation down at this year's CERAWeek. Power demand and how to fuel the AI revolution, that would have been the whole story, front and center. One company right in the middle of that is GE Vernova. The stock is on track for another record close. You're literally a broken record talking about this. It's up 160% over the past year. And Brian is back here with a CNBC First On interview with the CEO. Hi, Brian.
Hey, Kelly, thank you very much. Yeah, big run there. Scott Strazik is the CEO of GE Vernova. And I just want to say to you and also the viewers, again, we are potentially waiting for President Trump.
Yes.
If he comes out, I'll have to jump out. I don't want you to think I'm rude. My mom would get very upset.
No worries. Thanks for having me on the show, Brian.
That may happen. 160% gain on your stock over the year. Everybody I talk to here at Energy, anywhere I go, they say GE Vernova, GE Vernova. Tell our viewers, your investors who are watching right now, exactly where in the energy supply chain you are.
Well, we provide 25% of the world's electricity every day with our equipment through our customers. In the U.S., that's more than 50% of the country's electricity every day through our customers with our equipment.
Scott, sit tight. The President Trump is speaking at the Oval Office in Washington, D.C. Let's go to the president right now.
Citizenship. Ideally, you want to end mail-in ballots because there's tremendous corruption. Then we added a couple of things, Mark Wayne, like I don't think being a great athlete and having a family of great athletes, they have produced great athletes in this family, all-American wrestlers. They especially like wrestling, by the way. And what about baseball? Do you play baseball? Anything? They like wrestling. But I don't think that you would say that his family, and I don't know this for a fact, and I shouldn't say it because I could get myself, does anybody in your family want men to play in women's sports? I don't think so, Jim, right? I don't think so. I don't think. How would they do? Would they do good wrestling you? They would be in trouble? He said, yes, they'd be in big trouble. It's so crazy. So that would be one. And then we have a few others that we call them the best of Trump. But if you look at transgender mutilization of children, we don't want that. It's the mutilization of children. We don't want that. So generally speaking, I think I can answer that Mark Wayne would be very much in favor of what I'm in favor of. Would you say that's right, Mark? I can't think of too many things. He might be worse. He might be worse than me. That's my look at his wife is saying. That's right. But so yeah, he's going to be great. Yeah.
Do you believe the secretary will run DHS any differently than Kristi Noem did? What do you hope to see as his priorities?
Well, we had a good run. Look, we created the strongest border with the help of that man right there. Tom is so incredible. He's going to be a big influence here, too. There's nobody more professional, nobody better. There's nobody better as a human being. You know, he looks tough, but he's got a good heart. But not too good. Don't make it too good. But, you know, we had Tom. We have the safest border we've ever had. We have a lot of assets, but a lot of things we can do, and we're going to do. We have to get criminals out of our country that were allowed in by Biden. Yeah, please.
Do you support what appears to be emerging agreement coming out of the Senate to reopen DHS?
Well, I'm going to look at it, and we're going to take a good hard look at it. I want to support Republicans, and, you know, sometimes it's awfully hard to get votes when you have Democrats that don't want to have voter ID. They don't want to have proof of citizenship. They don't want to do anything about men playing in women's sports. That's one of the items we put on, you know. And I did that just because it's so popular. You know, they say that's at least an 80-20 issue. No, it's about a 99-1. I don't think it's, what do you think, Pete? Do you think it's 80-20? Who's closer, 80-20 or 99-1?
Almost 100.
Yeah, I think 100 is really the, so, you know, so I support that, and I support common sense.
Would you be comfortable with a deal that involves separating ICE funding from the DHS funding package in order to reopen?
Well, they're working on all of that. You know, that's a detail that they'll explain later. Please.
Integrity and DHS measures. Mr. President, since CISA falls under DHS, and given that many credible voices have raised concerns over its premature and possibly likely faulty 2020 election assessment, will you and Secretary Mullen implement reforms at CISA and at DHS to ensure full confidence in future elections, like in the upcoming?
About it. We'll talk about it. You know, pros and cons. Look, they used it to try and put me in prison, right? So I can't be thrilled with it. They used that very strongly, very illegally. The Democrats are thugs, and I don't want to say that. It would be nice to everyone get along, but it's a different country than it was years ago. It was very dangerous the way they used it. and they weaponize government. They use that to weaponize government. So I'm not thrilled, but I'll also go along with two groups of people, the military, and I think the military likes it, right? And I'll go along with the senators. I'm fine. But I was a big victim of it. Yeah, please.
Are you going to send Jared Kushner and Steve Witkoff to do direct negotiations with the Iranians?
Yeah, well, we're in negotiations, as it turned out, and now you've seen what I said yesterday was exactly correct. We're in negotiations right now. They're doing it along with Marco, JD. We have a number of people doing it, and the other side, I can tell you, they'd like to make a deal. And who wouldn't if you were there? Look, their Navy's gone, their Air Force is gone, their communications are gone. That's the biggest problem. It's very hard to communicate them between themselves. All of the anti-aircraft is gone. Most of their missiles are gone. We either shot them or they shot them and don't have them anymore. They're down to a trickle. Pretty much everything they have is gone. I don't know. Can you name one thing that's not gone, or can you name one thing that's doing well? You know, if you read the papers, you think we're tied. You think we're in a tough battle. We are roaming free over Tehran, the city, Tehran, as opposed to Iran. We're roaming free. We can do whatever we want. And as you know, today we were going to have the privilege of shooting down a very big electric generation plant, one of the biggest in the world. And one shot to the right location ends the plant, it collapses. And we held off based on the fact that we're negotiating. Yeah.
What was the turning point to make you want to pursue a ceasefire? A few days ago, you said you wanted to continue bombing Iran. Now you want to pursue peace talks. Was there something that happened?
The fact that they're talking to us and they're talking sense. And remember, it all starts with they cannot have a nuclear weapon. Just, I said yesterday, they said, what are the top 10? I said, well, number 1, 2, and 3 is they can't have a nuclear weapon. And they're not going to have a nuclear weapon. And we're talking about that. And I don't want to say in advance, but they've agreed they will never have a nuclear weapon. They've agreed to that.
How do you ensure they won't have a nuclear
Your
weapon?
former Border Patrol chief, Greg Bovino, said his only regret is that he didn't catch more illegal aliens. What's your reaction to that?
Who said that?
That's your former Border Patrol chief. He just retired.
Well, I mean, we captured a lot. They were allowed into the country by Sleepy Joe and that group of incompetent people that were, he was the worst president ever, the group of incompetent people. To me, that's the biggest scar. Inflation, they caused the highest inflation we've ever had. We've already gotten rid of it. The biggest scar is what they did, the people that they allowed from prisons all over the world. They came from the Congo, from all over South America. Rough people, really tough people. So, no, I understand what he means. He would have liked to have captured more. I'm not capturing so much as removing. We're removing thousands of people, and many are self-deporting because we're going after them so powerfully that they're self-deporting, Tom, going back. I think that's one of the big unkept secrets. We have thousands and thousands of people, and they're self-deporting. They're going back to where they came from. But what we want really is the criminals. We're really focused on those criminals, getting them out. Yeah.
What's your message right now to Democrats and also to Americans that are stuck in airports? It's really devastating watching it online because Democrats won't fund DHS.
What's devastating?
Your message to Americans right now stuck in airports as we speak because Democrats won't
Well,
fund
they just
DHS?
don't, they won't. Look, this is a deal that was done in the great big beautiful deal, which gave you the biggest tax cuts ever, including no tax on tips and no tax on Social Security for the seniors. Think of it, no tax on overtime, tax deductions when you buy a car, you take money, you pay interest on the money, you deduct it. We've never had that for people buying cars, if it's an American car, only if it's an American car. But they are just they stick together, the Democrats. I tell you, I give them great credit for that. We have some that they're not good stickers. We have guys like Tom Massey in Congress, who's terrible. He's just terrible, terrible person. I call him Rand Paul Jr. But they don't vote. Rand Paul, rarely votes for stuff. Likes me, says I'm a great president. He said the other day, I'm a great president, one of the greatest presidents. But I said, do me a favor, vote for us and don't call me a great. I'd rather have the vote than the statement. But we have people that don't stick together, and those people hopefully will someday be gone. The thing I most respect about the Democrats, even on horrible policy, they stick together. What they do have, though, is horrible policy. Transgender for everyone, open borders, men and women's sports. They have the worst policy that you can imagine. And so whether they stick together or not, I mean, they have just this terrible policy. We have great policy. Republicans have great policy. We have common sense policy, but it's great policy. That's our biggest advantage, is our policy is correct. Yeah, please.
President, are you encouraging our allies in the Gulf to be more involved in the Iran operation?
Say it.
Are you encouraging our allies in the Gulf to be more involved in the Iran operation?
Yeah, I mean, a little bit, but more NATO. I think our Gulf allies have been pretty good, to be honest with you. UAE's been hit so hard. He got hit by 1,400 rockets, shot them all out of the air with our great Patriot missiles. Think of it, they shot 100 missiles at one of our aircraft carriers, the Abraham Lincoln, one of the biggest ships in the world, actually. And out of 101 missiles shot, every single one of them was knocked down in the sea. Think of that. Think of what that means. 101 missiles, highly sophisticated, very fast missiles shot. Out of 101, all 101 were shot down, and now, for the most part, lie at the bottom of the sea. Pretty amazing, right? Pretty amazing. Our military is amazing, Pete. You know the attack I'm talking about recently? 101 shot. I said, wow. I saw that. You can see we have sort of pretty good equipment that we see. It's called the red line. Those red lines were thick, right? I said, that's a lot. And then we saw them one by one just get shot. And these guys that do the shooting are the coolest cucumbers ever. You know, most people, you don't have a lot of time. When a missile's going at 2,500 miles an hour, I don't care how far away it is, you don't have a lot of time. But I watched them sit down and think. Great students, MITs, a lot of MITs, a lot of guys like this. They're not as much into the muscle as they are this one right here. And amazing to watch them perform under great pressure, because they have a matter of seconds to do it. If they don't do it properly, it's a big problem, you know, because these were very powerful missiles coming. And so a lot of people choke. They don't choke. These guys don't choke. They're the best in the world. We have the best in the world, yeah.
Mr. President, what would be your message today to the TSA agents who have been staying home in recent days amid this impact?
Well, some of them are needing money, you know, because the Democrats cut off their money. I blame the Democrats more than anything else. But some of them, you know, they didn't get paid because they're not funded by the Democrats. This is a Democrat problem. In fact, I actually said to the Senate, why would you say this is a Democrat problem? I think the polls are showing us a Democrat problem. And they'll do anything actually to hurt our country so they can try and win the midterms. And if we ever went back to our old policies, we wouldn't have a country left.
If they get a deal, Republicans and Democrats in the Senate, to fund all but enforcement operations of ICE, to get those TSA agents repaid and to open up the rest of the department, would you sign that?
Well, I don't want to comment until I see the deal, but as you know, they're negotiating a deal. I guess they're getting fairly close, but I think any deal they make, I'm pretty much not happy with it. These guys came in, they wouldn't pay people. You know, they had a deal to pay. They had to break their deal. The Democrats broke the deal that we had. It was all done. Everything was fine. And then they just said, well, we're not going to pay anymore. And they hurt our country. And at a very difficult time because, you know, we are at, as they would say, a war. They call it a war. I call it a military operation. A very successful one. Successful like nobody's ever seen before. Hey, Venezuela was equally as successful. That was a great thing. No, the Democrats had a deal. It was a done deal. And then they said, well, we're not going to pay. And so a lot of people suffered over that and put our country in danger. You have another question? You haven't been here in a while.
Well, on Iran, can you give us any more sense of who exactly in Iran it is, either Witkoff and Kushner and others are speaking with?
Yeah, we had, I hate to say this in front of these young people, they're not children, they're I spoke to most of them. They sound like adults to me, even though they are sort of children, right? They'll always be your children. But I hate to say it, but we killed all their leadership. And then they met to choose new leaders, and we killed all of them. And now we have a new group, and we can easily do that, but let's see how they turn out. We have really regime change. You know, this is a change in the regime because the leaders are all very different than the ones that we started off with that created all those problems. So this was, I think we can say, Jason, this is regime change, right? I don't trust anybody. I don't trust you. I mean, that's only because I know you. But if I didn't know you, I'd probably have more trust. But I don't trust anyone.
Why bother?
Why do you say that? Why do you say what makes you trust? Do you think I trust them? I don't trust them.
Why bother talking to them?
Because they're going to make a deal. They're going to make a deal. They did something yesterday that was amazing, actually. They gave us a present, and the present arrived today. It was a very big present worth a tremendous amount of money. And I'm not going to tell you what that present is, but it was a very significant prize. And they gave it to us, and they said they were going to give it. So that meant one thing to me: we're dealing with the right people.
Related?
No, it wasn't nuclear related. It was oil and gas related. And it was a very nice thing they did. But what it showed me is that we're dealing with the right people. Because, you know, you don't know, because the leadership was killed, all gone. Khomeini, all gone. As the expression goes, the past supreme leader. And then the new supreme leader was racked up, at a minimum racked up pretty good, and everyone else was gone. And then many of the people in the third tier are gone. But we're dealing with a group of people that I think turn out, and the present, the gift they made to us was very significant, and they said they were going to do it, and it happened. And they're the only ones that could have done it. Jennifer?
To the Strait of Hormuz and the flow of...
Yeah, it was related to the flow, to the Strait, yeah.
Negotiating on who's going to control the Strait from now on?
No, we'll have control of anything we want. Look, if we can end this without more lives being down, without knocking out $10 billion electric plants that are brand new and the apple of their eye, I'd like to be able to do that, you know? But they can't have certain things. I mean, you know the things. I don't have to go over the list, but again, it starts with no nuclear weapons, and they've agreed to that. There won't be any nuclear weapons. They're not going to have, and they're not going to have enrichment, any of those things. But look, I hate to say that we're in a very good bargaining position, and I hate to say that they're defenseless because, you know, until that last missile is fired, they have little power. But we are in about the best bargaining position. We're way ahead of schedule. And again, they have no Navy and they have no Air Force and they have no missile protection, and most of their missiles are gone. Most of their launches we've killed. You know, we've killed about 82% of their launches. So even if they had a missile, they can't launch it. We've been very fast. We have the greatest military in the world. Nobody even comes close. We have the best military equipment in the world. Go ahead.
On Saudi Arabia, there's been some reporting that you've been talking to the Crown Prince. Have you been focused on normalization between Saudi Arabia and Israel at this point?
No, we have a great relationship with Saudi Arabia. What do you hear with Saudi Arabia?
Just hearing that you've been talking and that he has been encouraging you to do certain things related to Iran. Can you share a little bit?
He's a warrior. He does, yeah, he's a warrior. He's fighting with us, by the way. Saudi Arabia has been excellent, and UAE, excellent. And I will tell you, Qatar, incredible. Qatar took a hit, pretty bad hit. Qatar's very close, you know, they're essentially, could walk right over the border. Qatar took a hit. They've been great. They've been very strong. Kuwait, they had a little mishap. They shot down 3 planes with our missiles. They happen to be our planes, but the pilots made it. Can you imagine the pilots making it? The pilots saw what was coming, and they said, those are Patriots. We're not going to escape Patriots, and they got out of there pretty quick, Pete, right? Pretty amazing that they got out. The 3 pilots lived. They're fine. In fact, they're flying today.
Accidentally fired a missile?
Yeah, the Kuwaitis made a mistake. They fired. They thought they were firing at the enemy. It It was, as the expression goes, friendly fire. But the pilots are great. They're flying today. Pretty amazing, right? When you think of it. Yeah.
President Trump, on a human level, how hopeful are you that this peace deal will work out? Like as a human,
On what?
on a human level, not as the President of the United States, how hopeful are you that this peace deal will work out with Iran?
You're talking about to end it? Well, I think we're going to end it. I can't tell you for sure. You know, I don't like to say this. We've won this. This war has been won. The only one that likes to keep it going is the fake news. I mean, the New York Times, you read the New York Times, it's like we're not winning a war where they have no Navy and they have no Air Force and they have no nothing. And we literally have planes flying over Tehran and other parts of their country. They can't do a thing about it. For instance, if I want to take down that power plant, that very big, powerful power plant, they can't do a thing about it. It's like, take me. That's all they can do. And yet, if you read the New York Times or if you watch ABC fake news or NBC fake news, you'd say it's a close battle. It's not a close battle. They're totally defeated. You know, we killed their Navy in, would you say 3 days, Pete? Gone. In fact, I was a little upset with Pete. I said, why didn't you save the ships? We could have used them, right? He said it's more fun shooting them down. But the Navy was wiped out in a very rapid order. Pretty impressive for you guys, you champion wrestlers, right? When you hear this stuff. But you don't, if you read the news, you don't hear this. You know, you read like, oh, they're doing wonderfully. They're doing terribly. They're wiped out militarily. They are dead. Yeah.
Is there a new sense of a timeline? Do you want to get something done before the midterms?
Well, we'd like to see President Putin and President Zelensky sit down and make a deal. I think they're getting close, but I've been saying that for a while. I've settled 8 wars. All of them should have been more difficult than this one. This should have been the easiest one. But these are two people that truly hate each other. You'll find out that hatred is not good for making deals. These are people that they don't like each other very much. Yeah.
I know you said there's a bunch of people from the administration who are negotiating with Iran. There's been reports that the vice president is leading those negotiations. Is that true?
Well, he's involved in them. JD is involved, and Marco's involved, and Jared Kushner's involved, very smart guy, and Steve Witkoff, smart guy, is involved. And I'm involved. I'm involved. Why? Well, I'm going to be so big. Oh, I don't want to talk about it. I'm the President of the United States, Tom, and I'm not going to talk about it. It's beneath me to talk about saving millions of lives, because that's what you're talking about. You're talking about saving millions of lives. If Iran had a nuclear weapon, they would have used it. And if I didn't end the horrible Barack Hussein Obama Iran nuclear deal in my first administration, they would have had a nuclear weapon 3 or 4 years ago. They would have used it. I would have never gotten the chance probably to be president. Who knows what it would have been so devastating. And if we didn't send those beautiful B-2 bombers, they took them off my desk. They were right there. I don't know why. But if we didn't have those beautiful, the B-2 hit, which was so, we obliterated, despite CNN. CNN said, well, maybe the word obliteration said, no, we obliterated it. Just obliterated their nuclear potential. You would have had them having 2 weeks after that attack, had we not made the attack, they would have had a nuclear weapon. They would have absolutely used it. And they would have used it on the entire Middle East, including Israel. And you know why you see that? Because unexpectedly, when this war broke out, unexpectedly, they started sending missiles to UAE, Qatar, Saudi Arabia, Kuwait, Bahrain, and elsewhere. And nobody thought they were going to. Were you equally surprised by that, Pete?
Way more than we thought.
Pete, do you want to give about a 3-minute statement on how we're doing in this, as I call it, military operation? People don't like me using the word war, but so I won't. But the Democrats call it a war. How about a little statement? I think he's done a very good job. Do we agree he's done a good job, Mark Wayne? Can we take some of your time?
Well, thank you, Mr. President. You're spot on. Never in history has a modern military, Iran had a modern military, a modern Navy, a modern Air Force, modern air defenses, leadership, massive bunker. Never has a modern military been so.
And that was President Trump speaking live from the Oval Office as Mark Wayne Mullen was being sworn in as the new Secretary of Homeland Security. The president, of course, taking a variety of questions about the war in Iran, the economy, and more. The Dow is up about 76 points. It's kind of our most highly sensitive one because the markets are largely unchanged today, showing a little bit more optimism in the markets as the president has declared this war has been won. As it relates to negotiations, he says they're happening. He named Jared Kushner, Steve Witkoff, and he said, I'm involved in the negotiations. Eamon Javers is standing by in Washington with more reaction to what we just heard, Eamon, as the president continues to defend the war.
Kelly, he also said that the Secretary of State is involved, J.D. Vance is involved in those negotiations, but not saying exactly who the United States is negotiating with on the other side of this transaction. So not really clear who is in charge in Iran right now and who is negotiating with the U.S. team. The president also made what I thought was a really interesting but very cryptic comment about something that the Iranian leadership did. It sounds almost as if, and this is just a guess here, it sounds almost as if the United States demanded that they do something in order to prove that they actually had command and control of the Iranian state, and they were able to do it. The president described it as a present that the Iranians gave to the United States. He wouldn't give any detail about what that present was, how was it money? Was it something physical? Was it a gesture? We just don't know. But this is the second time in as many days the president has made cryptic remarks as to what's going on in Iran, alluding to things that he knows that he can't say. Yesterday, he told reporters that the Iranians had, there was some question about where the money was going to finance the Iranian oil purchases. So, are those two things related? Is there some rediversion of the money that's going to buy Iranian oil to some other entity? We just don't know as we stand here, but the president in 2 days has made very cryptic remarks about where the money is going that's buying Iranian oil, and now today about a present that the Iranians gave to the U.S. government. So we'll try to find out more. I'm not sure that the White House will tell us anymore because the president signaled that was as much as he wanted to share.
Right, but it's great that you picked up on that, Eamon. I also think people in the markets are highly attuned to this action the president keeps talking about that would be a bombing of the electricity generation plant that he says kind of basically powers Tehran or Iran. Now, a lot of observers have commented that that would be a war crime. But I think in the markets, while that's being prosecuted, whether or not that actually happens, the concern is what knock-on effects this escalation would have if it does escalate. So I think hearing him talk about the choice not to do that, whatever it would have amounted to, might give people a feeling that the most acute moment that might have happened would have passed.
Yeah, and I think that was the walk back yesterday, right? I mean, remember that the president had said that he would do that unless the Iranians, gave in. And yesterday what he said was, well, actually, the Iranians are talking to us, and so now we're not going to bomb any of their power plants, and we're going to allow them to have this 5-day grace period. So, is the president going to be intent on doing that? It's unclear, but clearly one of the things he wants to do is to preserve civilian infrastructure in the region so you don't have sort of mass chaos and breakdown of civil society in Iran after the war, presuming that he can still get a government in place that he can deal with, which seems to be his strategy as of right now.
All right. Eamon, thank you. Appreciate it for now. Eamon Javers at the White House. Want to mention some of these big moves we've been seeing, not so much in the stock market, but in the bond markets today. The 2-year yield was up 13 basis points at one point after a $69 billion 2-year auction this afternoon. That offering saw weak demand. Rick Santelli gave it a D. The rising price of oil is keeping investors on edge. It's tamed down a little bit. We're up about 9 points intraday now, and we're seeing some global bond moves influencing our 10-year as well. We'll have a lot more Power Lunch right after this. Stay with us.